let's just move everything to mobile on the phone. The old days of IT had training budgets. Why? Everyone knows how to use the apps on the phone. So it's profoundly changing the way that we work, and I think it's going to continue to flow through the organization. We have a big program of digitizing the company.
Does that translate into fewer employees as a practical matter because of the efficiencies from digital?
I think it for sure it changes into a different profile. I mean, people are having to adapt to doing things in a different way. We've actually made a lot of changes in our IT departments to move to a different skill set. So it's certainly changing the nature of employment and the sorts of profiles you want. Whether we buy the services ourselves or we buy the services or do it ourselves makes a difference as to where the employees are. But net, more employment's being generated in the economies.
So can Coca-Cola compete with Silicon Valley and the digital startups when you're trying to recruit the young computer scientists?
Well, Atlanta is a very fast-growing economy. The state of Georgia has been ranked, top 1 or 2 of place to do business in the U.S. for many years in a row. The local political system has done a great job, so has the city. So it's a very competitive economy there, and we do very well in it. We're happy to see Atlanta and Georgia growing, and they've done a lot to invest in tech startups and the media industry in and near Atlanta, and it's being very successful.
As you look toward really substantial growth in these new beverage categories, are you looking at acquisitions? Are you looking at organic growth? I mean, you have been inclined, I believe, to look for smaller brands, startup brands, bringing them along. Is that the future path to a significant degree for Coca-Cola?
I think it's going to be both. I mean, we have grown organically, but we have made these bolt-on acquisitions, as we call them, the little small ones, the niche brands. I think where we see that something is a really good idea, we invest in them. Sometimes we buy them, sometimes we just invest with them. But there's a quid pro quo. They get the capital that we inject, yet we can introduce them to the globe, not just the country that they've launched in. And that's helped us double the number of billion-dollar brands.
What's up, everybody?
Around the world. So I think it's going to be
good old Monday
strategy rather than one or the other.
I told myself I wouldn't trade on Sundays when the market
not a food
opens up.
company. I mean, there are some competitors who said, let's become a food company, at least in
you know how it goes, man.
Why
Sometimes
did you make that decision? And does it make you
yourself
any more vulnerable?
But luckily,
forgive me for saying, but
this
even
was the trade I made right here.
$200 billion market cap, it's a pretty big acquisition.
And it worked out.
But there's pretty big consolidations in the food
It worked
industry.
out. Actually,
I
set my take profit down here.
On beverages because that's where the greatest synergy
I
and the
actually
greatest application
took out
of our
the
know-how.
I set the take profit here on TradingView,
global bottling
but on MetaTrader I took it out because I think it was going to keep. I figured once it passed, once it get to this line right here,
one of the best growing,
it's going to keep dropping.
How
far? Who knows? So that's why I took the take profit away on this one.
We have a good position. We can create a lot of synergies.
What's up, man? How you doing? Hope the coronavirus
I sometimes say,
yeah,
man.
Never
say never, which then causes confusion.
It's getting crazy out here in the streets, man.
I say, no, it's a question of what's most logical. And beverages are the most logical thing for us to do first because we stick to our knitting. In terms of how
U.S. dollar, Swiss franc, I held this trade since last week, man.
Gold star, gold.
You know how it goes. Consolidation zone. So
growth is the name of the game. If the category's got no
growth,
then optimize the margin. Okay, but that's still silver prize.
GJ, another trade I had last week.
So I'm pretty clear.
This one, I knew it was going to drop.
Driving top
when?
Growth,
who knows, man? Who knows? But I feel it. I feel it right. Hey, I feel it. You know what I'm saying? You know how they always say,
with us over the long run.
When it hits its high point 3 times, it drops.
That's a lot of bottles.
For some of you guys who wasn't watching me last week, but you see right here, 3 times, 1, 2, 3, drop. That's normally how it goes. And this one, 1, 2, 3, drop. So let's see what happens. Let's see what happens. This is of course, I like to mark my support and resistance zone. So this is the line that I struggled to pass right here. That's why I marked that. As you can see, even in the past, I struggled to pass that line. So that's why I marked that. And on this trade, if it struggled to pass this line, I mean, it struggled recently too. That's why I kind of got this consolidation zone marked up. But, these are going to go up or it's going to go down. And my thought is going to go down only because, for one, it was on a heavy downtrend at the beginning. 2, it broke the trend anyway, coming back up. So, I'm just being patient. Let that sit. What's this? Disney? Ooh. You're trying to pay your boy. Let's go. What kind of look like? I should have put some more $8, but I wasn't sure. We'll see. I ain't even gonna get caught up. We still got a bunch of craziness going on right now anyway. So what is this? This is trading. It's called trading right here, man. So what you do is okay, so I buy stocks and I trade stocks and Forex. So what do you trade? Okay, so this right here says sell, this one says buy. If the market's gonna go up, you do a buy. If you think it's gonna go down, you do a sell. So this one, I think it's gonna go up. Oh, this is
great
cargo.
goal.
Not this
You
one.
have a big new packaging.
So this one, when you see the red facing up, that means I don't want it to go up. I want it to go down.
But as a business,
because I'm betting it to go down. That's why the green's at the bottom. Green means I'm in profit. So in this trade, I'm not in profit because it's in a consolidation zone. So we're gonna bounce up and down in this between these blue lines I got marked.
And one of today's biggest
on this trade, I think this one's going to go down because
we've done a lot on making things.
It looks like it's trying to form an M.
That's why I invested a lot of R&D making progress.
This
on
one,
using it. But we need
I
to
think this one's going to go down too.
So this
they always go down. It's just those are trades I've been holding over the weekend.
Which is collecting.
Some of like this one, I think it's going to go up. But I got in this trade last week. So I've already took my money out, so good on this one. This one already paid
into the future.
Same thing with what happened with this one. I was a bad trade.
How are you going to attract all that plastic? By 2030, you want to be getting a bottle back for everyone you put out there. That's a lot of bottles for Coca-Cola. How are you going to attract all that plastic?
Well, to give you an idea of the dimension, we need to bring back every person in the world. If they bring back 2 bottles a month,
so some of these trades,
we bring back all our bottles. That's our objective.
We're from last
2 bottles
week.
A month for every person. So we collect every bottle we
New
put
day.
out. How are we going to do it? Well, there'll be different systems.
Oh, this one
in
like it's trying to come back down.
Every country needs a solution, but it won't be the same everywhere. There are kind of places where it's reasonably advanced in Europe, to more informal economies where the collection happens. So there's going to be different solutions everywhere. We're going to have to work with NGOs, other industrial companies and governments to put in place these solutions. But it's absolutely doable. And I think that's what's
I'm just trying to find another trade to get in right now.
We're very conscious of this in the United States, but what about in other places, like China, for example?
Yeah, look, I think the emerging and the developed countries are where more of the problem is than the US or Europe, which is probably at the leading edge. So we need to do more there. But recognize that in a lot of these countries, there is some informal collection system already going on across a wide range of waste. What we need to create is the circular economy. We need to create value for that. So often in the case, and we did this in Mexico, for example, you go back a little more than 10 years, it was less than 10% of the plastic was recycled. Now it's 60%. How? The informal economy was collecting the waste, but there was no market for it. No one wanted to buy it. So we went into the marketplace and bought the plastic, invested in factories to recycle that and reuse it in our bottles. So I think there's a model there for the Chinas and other parts of the world on how to create value out of plastic and get it reused.
You've laid out a bold strategic vision for your company called Total Beverage Company. That includes things beyond Coca-Cola and even beyond Diet Coke. It goes on beyond that to these 5 categories. What's driving that? Is that basically to get away a bit from sugar drinks?
Actually, we're following the consumer. When you look at what's happening around the world, as the world is urbanizing, as people have got more disposable income, they're spending more money on a range of things, including beverages.
I want to say this is trying to bump back up.
Important within that growing market of beverages is they want more choice. Different people want different things.
The ones you don't really know how, you don't like how it looks, you stay away from them.
Serve the consumer. We've got to follow them. We've got to get into more categories. Coke is likely to remain the heart and soul of the company. It's the world's biggest.
Actually, you know what? I got this trade over the weekend too. I took the money from this right here.
Offer consumers what they want all day long. We have to offer choice. And I think that's what's going to guide us forward. And in a way, it goes back to where we started.
Look at that. I took my money out of this one already.
What the consumer wants.
But I took it out right here.
They will take us to where the business needs to grow. And then it ultimately ends up in growth for the business.
I understand that on average around the world, people consume about 8 ounces of a beverage per day. And Coca-Cola, I was told, is about a half an ounce. What is your goal? How much of the market share of total beverage can you really take globally?
I mean, I don't think there's a end of history moment when we reach
crazy,
Nirvana. I
Why is
think what
everything
we're looking to do is gain share every year. I mean, it's a competitive marketplace. We have a lot of well-funded competitors doing a lot of exciting things. So we're focused on is, can we serve the consumers and gain a little bit of share each year and generate a growing business system that our objective is to create value for everyone who touches that business system, whether it be the economics of the people who are in the value chain like the customer, or even society with initiatives like the packaging one, you know, which I think builds on our heritage of creating shared value in the world. You know, 10 years ago or so, we set ourselves the objective of being water neutral by 2020, and we achieved it a few years early. So we return to the environment all the water we use, which is one of the things that gives us confidence that we can achieve this packaging objective. So we get business growth and doing it in the
I'm gonna keep my eye on this one.
Most name brand bars and body washes you rub on your skin are classified by the FDA as synthetic.
I'm gonna keep my eye on this one too. This one look crazy, bro. I'm gonna keep my eye on this one too. What's this one? Euro Japanese? No, this is not the time. I want Oh my goodness. Euro Japanese yen. What's up, Connor? How long have I been trading? About a month and a week, something like that. So I've been learning around the time all this Corona stuff started. So I don't know if that's a good thing or a bad thing.
Stabilization signs. Investors and world leaders grow cautiously optimistic as the rate of infections and deaths slow, while Scott Mitered sees a potential for further 40% sell-off in the S&P. And Japan's a state of emergency. The country moves towards aggressively tackling the virus and paving the way for a nearly $1 trillion stimulus. And we're still waiting on Europe. Investors waiting on coordinated stimulus from the EU bloc, as Germany's finance ministers say, if you need help, just go ahead and tap the ESM.
I only started researching
Welcome
like
to Bloomberg
6
Daybreak
days,
on this Monday, April 6th.
Yeah,
I'm
it's
Alex
good to start with that demo account,
Welcome
man.
to a day where we actually see S&P futures up on a Sunday and into Monday. This feels like a totally weird universe now. We're not limit down on a Sunday night. The question then becomes, are we actually stabilizing here, or is this just some kind of a relief rally as we move from sort of the let's stop the virus from spreading conversation into how do we rehabilitate, into then how do we stimulate? S&P futures up around the highs of the session. Euro dollar, though, still getting a hard time catching a bid. 10-year yield seeing a little bit of a sell-off. You have supply coming online. The Fed's backing off about $10 billion in the Treasury market for this week. And oil, we had a big gap down overnight, but now we're off the lows of the session as well. Well, for more on the markets, joining me now is Jim Paulson, Luthold Group Chief Investment Strategist. Do you buy this stabilization weird world where futures are up right now?
I agree with you, Alex. It's weird to have a Monday morning that's green. But Yeah, I mean, I think, we've had market stabilization going on for quite a bit of the last couple of weeks, really, with
I have
the
no clue
market
what I'm
low,
doing, to be
11
honest. It's
days
okay.
ago now, and the
It
S&P
just takes
500,
time, man. I'm still learning
and
myself. Like,
certainly
as long as when you
seeing the
lose,
VIX come down, breaking, to almost
you learn why you
37 there
lose.
at
That's
the
the
end of
big
last
thing.
week.
Don't just lose
The
and be like,
bond
oh, I
market,
lost. As
10-year
long as you learn
yield
why you
set a
lose,
low on March 9th,
you'll win next time.
which it hasn't violated yet. We've certainly seen some cyclical
It's not that bad.
participation.
So, you can lose a couple
Leadership,
$100
again,
and
a
not
little
be
bit
mad
off the
about
low.
it from
So,
that. Like, I lost when I first
at a
started.
minimum, we
I
certainly
lost a
have
couple hundred. Well, when I was using
a rally
demo
going
account,
on, and we
and
certainly
then
have a
I lost a
calming
couple
a little
$100,
bit in
but
the
I wasn't even that mad.
abject fear and panic
I mean,
that
even
was
when I
evident
lose
just
my
a
real
couple
money,
weeks
because like,
ago.
okay, I know what to do
And
next time,
I do think
and the next
that
time
the
I make it
selling
back.
cascade, forced selling, all the ones that wanted out are pretty much out of this stock market. What we don't have yet is buyers in a big way, but I do think that if we could, the best news of all is a bend in the virus curve, and that's what's driving this morning predominantly. And if we start
Jim,
to get
I'm
more of
glad
that
you
in the
said
United
that.
States, then
I'm glad that you said that, because JP Morgan said something really similar, that if you are able to see the United States sort of be able to pare back the virus infections and deaths, that would be very supportive. So do you think that is like the real correlation that we're looking at? And I guess why? Like, why would the U.S. then matter more than, say, what's happening over in Europe, considering this is global?
Well, I just think that if, most of the curves have followed very similar patterns after China.
I think I got a good entry here.
Europe's showing a lot of evidence of that now. And
we will see. I feel like I got a good
entry
entry on this trade.
behind Europe, and maybe we're very close to where U.S. is going to show more broader signs of bending the curve. And if it does, then I think
I'm not going to be in this one long,
the real problem of the worst pressure on U.S. hospitals starts to diminish. And
this one looking good.
And then I think that opens up the possibility.
I got in this one last night before I went to bed.
The economy, at least in a partial way.
So I woke up and profit.
We're going to have, massive unemployment.
This one's still
maybe
moving
as
sideways.
30%, and you're going to start to get some public outcry just to want to go back to work if the intensity of this virus is diminishing to some extent. So I think we're going to see, if that happens, we're going to see economy restart, and it gives the market maybe the first time to be able to look beyond this crisis a little bit and start to discount not too distant future where there's actually growth coming again in the latter part of the year.
So talking about growth, I feel like what we would be talking about if this was any normal year would be banks' earnings season, and earnings season that's coming up, and sort of what are we going to learn? What's the growth trajectory going to be like? What sectors are going to do well, et cetera? How can we have that conversation when there's no visibility? And not only that, but this key support of the market, buybacks, feels like it's going to be decimated for a while. How do you then appropriately value what you should be paying for these companies?
Yeah. I think the data has been debunked for a while here. If you think about it, the good data we had in January and February was largely ignored because everyone knew what was coming. And now that the bad data is coming, we knew that was coming. The market had already kind of adjusted for that. I don't really think the earnings reports in this season are going to be that relevant because everyone knows they're going to be horrible. And so I don't know. I still don't think we're reconnected yet with data flow, Alex. That would be a wonderful thing to do that. But I think the market, like they have for a while, are going to continue to look through data, and it's going to be all about where is the point at which the economy, the on switch, starts to turn on again, and we can look at some realistic data of fundamentals again.
This one need to stop playing with me, man.
The switch off in the economy, all the data plummets, but it's more like there was an earthquake, and earnings data after an earthquake, are not going to be good. But once
this one looks real healthy,
cleanup project in place, then you can get back to where does earnings shake out. But I don't think we're going to know that.
Well, it's a 4-hour candle, so
part of the year. What we do know is there's been incredible carnage in these markets. The S&P fell 34% at its worst, but the broader market, the Russell 2000.
I think I got a good entry on this one.
I don't know how far it's going to drop. 40% plus,
it's fine.
45%
profit is profit.
plus. So there's been incredible damage. And then you look at how low yields have gone.
I got a good entry on this one too.
Financial support coming from policy officials. You look at how much spreads have widened in credit markets. So we have a situation.
I just gotta hope it goes up and don't do the old.
Lousy, but we also have priced.
You know what I mean? Like, I hate when it does that.
The question is, how long does it last before we get some semblance of recovery from this? And if that comes in, in the late summer and into the rest of the year, then I think the market from these levels will look through a lot of that bad data.
But it pulled back.
Then I guess the easy question for me to ask is then what do you buy?
It made a
because
pullback.
What worked in the last 4 weeks was momentum.
I got in.
Which I don't think necessarily many
so
were,
I'm just
were
hoping
expecting to
that,
work.
This is just
in
a little recovery. That makes sense, right?
Low volatility stocks did not work
and
necessarily. REITs got completely hammered. You can't necessarily rely on good dividend
I'm on the
pairs
GJ.
because you don't know the dividends are going to wind up being there anymore. So where is the safety?
Well, there was a defensive failure. I wrote a piece a couple weeks ago.
GJ is in a consolidation state. Actually, right now is a good time to get in. But I mean, I've already got in, so I ain't gonna get in again.
Pretty much fully
I got 2 positions open. But if I only had one open, I could have got back in.
Look at the other side now. We're going to probably stay volatile.
That'd be all right.
We'll probably go down and re-challenge these lows at some point. But I wonder if most of the damage has already been seen. In the sense of we will go down to those lows maybe, but maybe not go a lot lower. So you have to start thinking about offense again to some degree. I think that I would use, down days here to add more overseas exposure. I would look to add more cyclicality, whether I look at financials, whether I look at industrials, some extent. I wouldn't necessarily go after the airlines or the cruise lines, those kind of things, but there's a lot of I think, good industrial companies and financial stocks that have been well capitalized that are going to get through this, and there's probably quite a bit of upside in the more cyclical parts of the stock universe, and I think defensive sectors will probably trail on the way back up. So I'd still own some defense, but I think I'd start to lean more towards offense a little bit here in the next several months.
Really appreciate it, Jim. Really good to talk to you. Thank you very much, Jim Paulson.
Oh, you doing options trading? I'm doing.
Coming up on the program, one sector that was really beaten
I don't even know what it's called. I guess regular trading. I'm not.
Energy. We're going to talk about oil pairing losses on signs that maybe Saudi Arabia and Russia can get together.
So when you say put, I don't know what that means.
We'll be speaking.
I'm not doing options trading. I'm just doing regular trading, where you just do shorts and longs. Yeah, I don't know much about options. Is that what you're doing? Options trading? The platform that I use is called MetaTrader 4. That's why I usually trade on this website that you see. It's called TradingView. So what does put mean? Does that mean you're betting against the market? The only thing I know is short and long. And short means you think the market's going to go down, and long means you think the market's going to go up. Or some people might say buy or sell. Y'all don't forget to like this video, subscribe, follow the page, all that good stuff. Oh, put me sell? Yeah, well, if that's the case, then that's what I'm doing on this one. I'm selling this one. Yeah, it's just that I don't know what it means when people say put, because I don't do options. You know what I mean? But if put means sell, then that's what I'm doing here.
With your tariffs.
That's
Very
what I'm doing
substantial
here.
tariffs, because we're independent now. We have our own oil.
So if you look
I
at,
would use tariffs.
I'm looking at, well, I'm also trading on the forward
I'm
chart.
going to have to.
So as you can see, it was on the uptrend, and then it broke its
That was
trend.
President Trump saying he doesn't
So it's in a
think he's going to have to
consolidation state
impose
right
tariffs
now.
on imported oil to blunt the impact of a price war between Russia and Saudi Arabia, despite the fact that guys like Harold Hamm of Continental want him to do that. For more, we're joined now by Sarah Emerson, ESAI president. Sarah, so I guess the most prevalent question is, in terms of then what's going to pressure these companies to do anything, is when do we hit global tank tops?
Well, that's a great question. I don't think we're there yet. We still have a couple of months that I think we can continue stocking through April, because global tank tops is, it's a pretty big number.
You from Ireland? MetaTrader 4 is
it's
just
not
the
necessarily
software
the
that you
right
use to trade
location.
on. If you just type in
So
MT4,
you sort of have to move crude around and
it's
swing
all
product
about
around.
if you're a
I think we
broker
still have
accepts it
another
or
month
not.
of
That's what you
stocking
got to look at.
before we're going to really feel that we're brimming.
So if we have a production cut by, say, U.S., Russia, or Saudi Arabia, or some combination of anything, does that actually prevent tank tops? Does it delay it, or does it just help the back end of the curve?
Yeah, I think it just helps the back end of the curve, because you're building inventory now, and that'll be in place, and then you're cutting production to work against a continuation of the coronavirus impact on demand. So what you're doing is you're sort of you're tempering the inventory increase and hopefully leading to a situation where the second half of the year you're actually drawing inventory. So that inventory that we're building up right now, that kind of remains a bit of a weight on the market for some time. But it should gradually retreat if we cut enough.
So based on that, it seems like we could then see even weirdly steeper contango, where you have front months a lot cheaper than the back months, while the curve actually rises, no matter what OPEC plus, maybe plus does.
Yeah, I mean, basically March was ground zero. We started building a lot of inventory, and remember, any production cut's not going to be immediate. So April is another month of fairly significant stocking. So yes, I think contango continues. It could get deeper. But at the end of the day, we could be looking at prices in the high 30s by the end of the year.
So what kind of cuts do you expect? And you raised a great point as to when production can come off. So I guess it's a twofold question then. Who cuts, and how quickly do the cuts reverberate within the market?
Well, so you have to think about the involuntary cuts first, and that's really the non-OPEC countries that will not participate in an agreement. And they're already beginning to cut back. Or they're announcing that they will be cutting back. And that would include even U.S. shale, whether it's through the Texas Railroad Commission or not. U.S. shale will definitely fall over the next 6 months.
I got a buy limit here.
How much will that fall? We've done a sort of our sense
for when it hits $3.50.
3 million barrels a day out of the non-OPEC community, including the shale piece. Then on top of that, you've got the Russia piece. And we think they will also have a lot of pressure on involuntary cuts, too. And then, of course, you've got all the OPEC countries and the other sort of friends of OPEC. And, I don't think they need to cut 10 million barrels a day. I think that's an odd thing that people are sort of latched onto because of the president's statement. Because it's how many months do you keep production cut? And people are looking at the 10 million because they're trying to fix the problem in 1 month. Well, that's just not going to happen. So maybe they cut 3 million among them. But they maintain that cut through December. And that's what happens. You begin to chip away that inventory then.
Well, that's a good point in terms of then how long it maintains. I guess the final question then is, why don't the countries just cut exports now? That would be like an immediate thing that everyone could do to help stabilize everything then in the oil market.
You mean in the United States cut exports?
Or, Russia or Saudi Arabia, just stop exports, stockpile a little bit, wait until the front of the curve gets a little bit better, and then they can deal with production, how long that's going to be cut for.
Well, we're into April now, and the way this works is you nominate.
That's a nice downtrend,
customer
too.
nominates, this is how much of my contract I want to take this next month. And that sort of is already in the pipeline. It's already on the ships. It's already being delivered.
I'm gonna ride this one out for a while.
Almost
I wish I used the
history
bigger
now.
stop lot.
So now you're really talking about would they cut in May, and that's why you probably saw the Saudis held off on announcing their contract pricing for May, because they're still sort of waiting. Well, maybe if we get everybody on the around to cut, we can actually reduce in May, and that would change our pricing. So April's done, in a way.
Well, fair point. Sarah, really good to get in touch with you. Really great read on supply and demand dynamics. Sarah Emerson of ESAI, thank you very much. And coming up, we're going to focus on yet another sector hit by the pandemic, and that's bank earnings. Wells Fargo Mike Mayo has reduced his estimates for a fourth time. This comes as JP Morgan in an annual letter says he sees a bad recession, echoes of 2008 crisis coming up ahead. We'll break it down. This is Bloomberg.
You're watching Bloomberg Daybreak. I'm Vivian Hurtado with your Bloomberg Business Flash. We begin with first quarter sales at BMW plunging more than 20%. The coronavirus hitting all of the German automakers' markets. The flagship BMW brand, Mini and Rolls-Royce were hit. Car makers in Europe have shut down their production lines. In 2 weeks, BMWs are scheduled to resume operations. Now we end with Jamie Dimon warning a bad recession is on the way. The CEO of JP Morgan just sending his annual letter to shareholders. He writes the coronavirus pandemic will trigger a major economic downturn. Plus, he says it will create financial stress similar to the crisis of 2008. Mr. Dimon writing JP Morgan cannot be immune to the effects. Still, he says the bank is unlikely to cut its dividend. And that's our Bloomberg Business Flash. Alex.
Thanks so much, Viviana. So for more on banks, we're joined by Mike Mayo, Wells Fargo Securities senior bank analyst. Cut his bank earnings estimates for a fourth time, but expects banks should still grow book value and generate more than 10% returns in the second half of 2021. Mike Mayo joins me now. Hey, Mike, really great always to catch up with you. So fourth time you've downgraded it. Total, you're looking at 40% decrease in earnings versus pre-virus levels. Are you done? Is it going to get worse than 40%?
Yeah, this is really amazing. I mean, each time we think we're where we need to be, and then we have to cut estimates again, as you said, for the fourth time. Banks are about to live the stress test that they've been practicing for a decade, and if successful, this could justify a re-rating higher. But first, it's earnings hell. No large bank is immune to the negative impact of higher unemployment and lower interest rates, and now we have credit losses up 2 to 3 times, earnings down maybe by a half over 2 years. And look out for negative guidance when banks report next week. And meanwhile, the U.S. government has a gargantuan task to make the stimulus work, getting the right money in the right place in the right time for something that's never been done before. So, yes, these are sobering times. Reported unemployment will likely pass the level of the global financial crisis. And the hope is that the government efforts cushion the impact and take maybe 15% headline unemployment and make it feel like under 10%. So the quote, feel like unemployment is what will matter more for the banks.
Mike, can we start distinguishing which banks are going to be worse off? Because you mentioned, lower interest rates and high unemployment. The Small Business Administration sort of trying to disperse those loans through banks. That's been a super rocky start, which has execution risk. So which banks are more exposed to all that, and which can benefit from, say, more volatility, more trading? We've seen some crazy trading numbers coming out of the banks, an early read for what we saw in the first quarter. Can you help me distinguish?
Well, first I'd like to make the point is we ran over 100 earnings models under all sorts of scenarios, so we're deep in the numbers. And if you look out over 2 to 5 years, I know that's longer than many people's time frame, almost every large bank would be a buy. Having said that, there are some banks that are more exposed to, lower interest rates than others, such as, Comerica, which we have a sell rating on. On the other hand, we go either, high beta, banks that benefit from high volatility, or high quality. So high beta stocks would be companies like Citigroup or Goldman Sachs, which can benefit from volatility, although we reduced our estimates on them too, or high quality banks such as PNC and U.S. Bancorp. And you mentioned JP Morgan, they're also high quality. And, calling for Jamie Dimon, we will finally hear from him for the first time next Tuesday when they report earnings. So he can remind people why JP Morgan's of quality, how they have over $1 trillion of liquidity, JP Morgan itself, how they run daily stress tests. And you know what? It'd be even better if Jamie Dimon would buy stock again. He's done that during prior periods when the stock's taken a hit. So I think the industry has a potential boost when Jamie Dimon returns next Tuesday.
Well, I'm glad you brought up sort of the internal buying back of stock. If we broaden it out to the general buyback of stock, over in Europe for European banks, it's no buybacks, no dividends, full stop. I mean, that is now sort of a regulatory thing because they want to shore up their own balance sheets. Do you feel like the same thing could happen here? And if so, how do you revalue bank stocks?
Well, like I just said, we've run the math every which way, and even after our fourth estimate cut, and even if we had a few more estimate cuts, we still think that banks would earn the dividend. If banks can earn the dividend, then banks should pay the dividend. And the difference versus European banks is that European banks return almost all of their capital through dividends, whereas U.S. banks return a lot of their capital through buybacks, which have already been suspended voluntarily. So I do think it's quite different. And the U.S. banks recapitalized early last decade with a lot more capital. They did it sooner than the European banks. They earned more money. And the other issue is that, or not issue, the mitigating factor here is that, banks are likely to cut expenses, and, the amount of dividends equal about 17% of expenses. So banks will be taking, creating more cash flow and earnings through that mechanism too. So, no, I still prefer that being left up to the shareholders. By the way, I will be asking about these types of topics at the annual meetings, and the reason I go to bank annual meetings this year, they will be virtual, is simply so that shareholders can hold the companies accountable for areas such as dividends and pay and bonuses and all that, as opposed to the government.
Mike, I really appreciate you coming on with us for that, talking through your fourth estimate rating cut. I'll miss your props, though, so maybe at some point on set we can get you back for some of those props. Mike Mayo joining us from Wells Fargo. Well, coming up, staying within this world, taking a look at real estate and where the opportunity is and where you're going to see even lower prices. I'm going to speak exclusively to Al Raybill, Kane Anderson Real Estate CEO. That's coming up next. In the markets, you're still seeing something weird, and that's sort of positive equity futures. You had green on your screen yesterday overnight, and we're continuing that with S&P futures up now by about 86 points, slightly off the highs of the session. We'll break that down. This is Bloomberg. Welcome to Bloomberg Daybreak. I'm Alex Steele. So in the market, has been saying all morning, something you don't see every day, especially on a Monday, and that is actually S&P futures right around the highs of the session, following European markets higher as well. If you switch up the board, though, you can see where some interesting action is taking place. I want to highlight a euro dollar, also the yen, both lower against dollar, which is interesting because the euro can't seem to find a bid, even if governments may come to the rescue, and the yen a little bit weaker potentially because you have a $1 trillion stimulus potentially coming out of the country. Also some reports there about Tokyo, for example, being in lockdown. Also want to highlight some bear steepeners happening here in the Treasury market, and the VIX sort of calming down. Crude still getting hit, but not as bad. Germany is planning some limitless credit program for small companies. So again, sort of the backstops of the regional governments. But the question for Europe is, can they all kind of get together and make it work? Well, here in the U.S., it's been all about Trump's administration's $2.2 trillion stimulus measure. The idea, though, is that it doesn't really help homeowners to delay payments for months. Some investors are saying this could be actually a huge opportunity. Joining me now is Al Raybill, Kane Anderson Real Estate CEO and managing partner. He oversees over $8 billion of real estate assets across medical office space, senior housing, student housing, and more. Al, it's really great to talk to you. You're sort of in the middle of all of it. First question is the losses. What kind of defaults, postponement on loans, et cetera, are you expecting as you're exposed to all these different sectors of the market getting hit?
Yeah, it's a great question. I think obviously it differs sector by sector, but we're specifically in medical office, senior housing, student housing because of the recession resistance and the strength of those asset classes, specifically in an environment like this. I would point to, we actually don't own any existing student housing assets at this point in time, so we're largely allocated to medical office and senior housing. On the medical office front, I would say that medical office, we have seen no defaults. We expect no defaults. We've got very strong tenants. We've got long leases, and obviously from a longer-term perspective and even a near-term perspective, you're going to have continued demand there. On the seniors housing side, first off, I'd like to just give a shout-out to many of the best-in-class operators within this sector who are truly first responders. I will tell you that we've been coordinating response efforts for supplies, best practices, bailout resources with many of the largest owners in the space. So that's incredibly heartening, and I think shows the true makeup of many of these people. I would say the sector, especially the best assets and operators, will ultimately benefit from this downturn. Obviously not how anybody wants to, because I think pre-2025 you will have essentially a shutdown of new supply. I do not see any permanent degradation of capital on the seniors housing side. Obviously, you've got a near-term issue, and that near-term issue, first and foremost, is a healthcare issue. You will see some occupancy declines, et cetera, obviously, through the end of the year, but I think you'll see that rebound strongly starting next year.
Mm-hmm.
So I'm
Al,
looking at near-term pain in senior housing. Sorry, I was just going to say near-term pain followed by longer-term gain.
So where else are the longer-term gains? Like, where are you seeing the biggest price dislocations that now provide opportunity for you?
Right now, we're very active actually on the debt side of our business. So we've been actively acquiring Freddie Mac bonds at pretty deep discounts, given the dislocation that you've seen in the debt markets, obviously well publicized and talked about on this show many different times. Obviously, you had mark-to-market margin calls over the past couple of weeks, and those will continue and put incredible stress on the debt markets. We've seen Freddie Mac institute a forbearance program. We're very bullish on government agency bonds, particularly if we can acquire at the right prices. We think that ultimately the multifamily sector is going to prove very strong, and the government has shown not only a willingness but very quick action response in terms of injecting capital into this space. I think what you're going to see on a going forward basis is the U.S. government will have to and will provide capital to mortgage servicers to support the agency-backed mortgage market. But we are looking at both debt and equity opportunities in which to invest, and I would say we're active on the equity side as well, because our view is that the asset classes in which we invest are very resilient and we're looking at some significant discounts to, if you can close your eyes and open them a year from now, to where values will be.
I would take just closing them for a month and then reopening them a month from now. Is that also because the Fed is sort of backstopping it? Yeah, I noticed that you didn't mention, say, non-agency backed mortgage securities. So is this also just a Fed play?
I think that dollars are first going to be allocated to non-agency debt, whether, to agency debt, whether you will have some kind of support on non-agency debt. Don't know what that will look like. That's a completely different animal. I think that, in many cases you've seen companies on the non-agency debt side, use debt inappropriately, and many of those players are, asking for a backstop. We'll see how that plays out. We're specifically focused on the agency debt side at the moment, and we expect to see capital infusions first to that, and maybe only to that. But I do not think we're looking at the crash of the real estate debt markets.
Do you think that if the Fed was able to backstop non-agency mortgages in some capacity, would that be a good buying opportunity for you, or you're going to stick to your guns on this one?
I think we focus on specific opportunities where we've got outside knowledge. So that could include debt that is backed by medical office properties, senior housing properties on the non-agency side for sure. Obviously, we've seen pain in many of the mortgage REITs, in many of the hedge funds and private equity sponsors who have used shorter duration debt to finance longer duration holdings. And so we will look across the debt markets to where we see value. So we're not going to limit ourselves only to agency debt, but I think we will be opportunistic yet cautious at the same time.
Are you selling anything right now?
No. We have, fortunately...
Have you been hit with any margin calls of yourself or anything along those lines?
No, actually, we're incredibly well positioned. We structured our most recent debt fund without using any mark-to-market margin call. So we have a very unique structure where we use note-on-note financing. So we took no duration risk, no mark-to-market risk. We have no margin calls. We have no defaults in our portfolio. So we're pretty uniquely positioned to take advantage of the current opportunity. And while on the senior housing side, our operators are working hard every day, and in fact, we haven't even experienced occupancy declines on the senior housing side, but we're extremely well positioned to play offense in the current downturn.
Al, I have a question from a viewer who's going to want your outlook on retail real estate, even though you don't necessarily own it, but to get your outlook on retail real estate, especially malls, like it pertains to companies like Simon Properties, for example, sort of how that plays out now over the next year.
Yeah, retail isn't my area of expertise. I will say I've been bearish on retail for a long period of time. I had serious questions pre-COVID-19 on the mall business and retail in general. I do think that we will see tremendous changes in the economy and the way that people act, the way that people shop, and the things that people do in a post-COVID-19 world. I don't think that retail as a whole, at least bricks and sticks, will be a beneficiary of that. I do think that retail, when you're looking at the internet, will emerge, incredibly strong, because I think what you're seeing is, behavior changes where people who have never even used the internet to order are now ordering, online. So retail is not dead, but I do think that the trend line that was already in place will continue on a going forward basis.
Al, really good to catch up with you. So many more questions. You'll have to come back in a few weeks to chat about it. Al Raybill of Kayne Anderson, thank you so very much. We do want to give you an update now. It's making news outside the business world. Viviana Hurtado is here with First Word News. Viviana?
Alex, we begin in Spain, the nation reporting the lowest number of new cases in more than 2 weeks. This is a sign Europe's largest outbreak of coronavirus is slowing. In the last 4 hours, there were fewer than 4,300 new infections. 637 deaths. That's the lowest number of fatalities since March the 24th. The Trump administration says there are signs the U.S. coronavirus outbreak is starting to stabilize. President Donald Trump and Vice President Mike Pence pointing to a day-by-day reductions in deaths in New York. Still, the U.S. Surgeon General warning Americans to brace themselves for tragedy. He said this week will be the hardest and saddest of most Americans' lives. And we end in the UK. That's where Prime Minister Boris Johnson was in the hospital for the coronavirus. PM Johnson's illness was originally described as mild. There's no sign it's getting worse, but his doctor urging he be admitted to the hospital for tests because symptoms have not cleared up. Global news, 24 hours a day on air. And a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Viviana Hurtado. This is Bloomberg. Alex.
Thanks so much, Viviana. And turning now to how companies worldwide are responding to the pandemic's health challenges, we got a couple ones for you. Tesla showing off a ventilator prototype. It's made from car components. And according to a video from the electric car maker, the design includes a touchscreen, computer, and control systems from a Model 3 car. There is a shortage, though, of ventilators needed for coronavirus patients. Meanwhile, you have Apple coming up with 20 million masks through its global supply chain and is designing another piece of protective equipment.
We've launched a company-wide effort bringing together product designers, engineering, operations, and packaging teams, and our suppliers to design, produce, and ship face shields for health workers.
Apple plans to ship over 1 million of the shields this week. I just want to see if they're like super cool, like high-tech, sci-fi kind of things. All right, well, coming up on the program, we're taking a deep dive into the ethanol world, its downward spiral, the demand for the biofuel creating from the coronavirus and oil glut. What happens if oil still trades around $25 a barrel? We'll break it down with Todd Becker, Green Plains' CEO, coming up next in today's Bottom Line. And remember, users, if you're looking at any charts throughout the show, go right to GTV Go on your terminal. You browse all the features and check it out. This is Bloomberg.
This is Bloomberg Daybreak. I'm Viviana Hurtado, and you're looking at the Principal Room. Coming up later today on Bloomberg Technology, Tony Xu, DoorDash CEO. Bloomberg Daybreak, I'm Vivian Hurtado with your Bloomberg Business Flash. Boeing will keep its Seattle area airplane manufacturing hub closed indefinitely. The factories were scheduled to reopen tomorrow night. This after a 2-week shutdown, but state health officials are still trying to contain a coronavirus outbreak. Boeing suppliers are also showing signs of stress. And we end with Rolls-Royce. Reportedly, it'll scrap its profit targets this week. For the first time since going public in 1987, it also will suspend its dividend. All this according to the Financial Times. Last week, shares of the jet engine maker plunging 31%. I'm Vivian Hurtado, and that's your Bloomberg Business Flash. Alex.
All right, thanks so much, Viviana. Time now for Bottom Line. We take a look at some companies worth watching this morning, and today we're going to focus on one in particular, and that's Greenplane Energy. We're joined now by the CEO, Todd Becker. The company stock has seen almost a 77% drop in the year as the oil rout and the outbreak of the virus slowed demand for the corn-based ethanol. Todd, I always love catching up with you. There are two prongs to this story. First, let's just take the general virus story. How bad is demand down from people just not driving?
Yeah, I think that's the key to what's happening right now in the market. You've got driving demand last week was down 27% in the United States. We're seeing some areas of the United States as high as 80% down. We're seeing it really through nominations coming from our customers who want our product or actually don't want our product right now because demand is down so far, both domestically and globally. It's not just a domestic story. We export a lot of our ethanol as well, and we've seen some of those customers completely back out of their contracts and calling force majeure, as they say. So we're really seeing a big drop in the product right now, and that's really wreaking havoc on this industry.
Do you have any visibility into China, where areas have started to open up, in terms of what kind of rebound we can expect when things get a little bit better?
Yeah, I mean, we're seeing them sniff around a little bit right now. They bought some corn, they bought a little bit of soybeans, but those aren't really big deals relative to the demand that we have domestically for agricultural products and ethanol. And so, we really haven't seen them come into the ethanol market. It's really the Brazilians that have started to slow down taking our product in other parts of the world. But China is sniffing around, but thus far we have not seen them book any of our product out of the United States. But they need it, and they need it badly. And so they could really make a big dramatic shift on this industry. And we think through the trade war negotiations that ethanol was part of the solution, and we're really just waiting for them to come back into the market. But at this point, we're really not seeing them return to the global markets in any way, shape, or form for ethanol.
So where the industry was before is also a good indicator of sort of then when we go back to some kind of recovery phase, what it looks like. There were higher expectations for a higher ethanol blend, like E15, for example. And so 15% of what you blend for a gallon of gasoline has to come from ethanol versus 10%. They were talking about more exports, for example, some policy shifts to wind up help ethanol producers. Where is all that conversation right now?
Yeah, I mean, that's basically, some of the issues we had. We were already oversupplying the market as an industry. So this industry has a long-term idea that, we make a little bit more product and we wait for the demand to catch up, and the demand really hasn't caught up. And it's really from an overzealous EPA that somehow favors oil over ethanol, somehow favors, doesn't look at clean air and clean water as much as they look at favoring the oil industry. And it's kind of mind-boggling. But through all that, we're just overproducing just a little bit more than we need every single day around the world. And we really need E15 expansion, and we really need the EPA to clear some of the last hurdles. The president is very supportive of E15 and 15% ethanol blends. It's really this EPA that needs to change a few more factors and get the product into the market. The consumer wants it. It's cheaper than normal E10. It's 88 octane. It really is a great product. It hasn't seen not one claim has come after several years of using it from the consumer. So, that's part of it. And really, we compete very well with the price of gasoline. We have for a very long time. But, when you're fighting for share of the gas tank, it's a big battle. And so we're starting to see E15 roll out across retail platforms. But in some of the branded stations, the big brands, they're still under their own old fuel contracts. And so it's been a hard battle. But we're starting to make some progress. But we really need that. We need China to come back into the market. And we really need to temper our expectations on some of the supply that we put out there as well. I mean, we need to slow down as an industry. And that's really starting to happen right now just because of the coronavirus. But overall, it probably needs to stay that way for a little while longer.
You say you're competitive with gasoline, but are you competitive with gasoline if it's like $1.90 a gallon?
Yeah, and I think that's really the big question, and I think that's the big thing that we're looking at. Corn prices are linked to energy, as much as people don't want to admit it. The corn versus crude spread that we've looked at a lot is really at record highs favoring crude. So corn as an energy component is just priced too high. So when you think about oil at $25 and gasoline at 65 or 70 cents, ethanol is priced a little bit too high, and that's really driven by the price of corn. And so as this industry shuts down through the coronavirus, we're really destroying corn demand. And really, the ethanol industry is the backbone of U.S. agriculture. So without a strong ethanol industry, we don't have a strong agricultural economy because we're going to take 1 billion or 2 billion bushels of corn demand off. And so it just says that these corn prices are so high relative to crude. If you just lay it over as a ratio, you would see that. So we can be competitive. It's just a function of the agricultural price structure being competitive with the energy price structure long term. And we've been able to achieve that in the past. And just oil just came down so much faster than the price of agricultural products. Mm-hmm. But I think we're starting to catch up with that a little bit as you start to see the price of corn start to come down as well.
So that's an interesting sort of cross-section between all three parts of the commodity world. For your business specifically, what kind of levers do you have? You've already done lowering production costs. You've been divesting assets. Like, how many more levers do you have to pull at this time?
Well, for Green Plains, I mean, we're just priced incorrectly. I mean, we have a single asset out of a lot of our assets that's worth more than the equity value of our company. But, look, people are looking at the overall macro and saying, who's going to make it and who's not going to make it. We're very convinced that Green Plains will be around for a long time. We paid off our $500 million term loan. We have a lot of liquidity and a lot of cash in the bank. In fact, we have probably more cash than our equity value as well. We have very little debt left. So it's just a function of cyclicality, and we're in a down cyclical trend because of the coronavirus, because of China, because of E15, because of the trade war. I mean, you just go on and on and on. It's basically the triple whammy. So we need to come out of this, but I think the silver lining out of all of this is that when we come out of the coronavirus, you have to think that people are probably going to drive a little bit more before they start to take long haul flights. And so we think overall coming out of this longer term, it's bullish gasoline prices. It's bullish driving miles in the United States. We have been stable at 143, 144 billion gallons of gasoline demand a year, and ethanol is 10% of that. And, so coming out of this, what will the behavior of the consumer be? In our view is that when we look at that, the consumer drives more, China buys more, and the agricultural prices compete with energy prices. So we've set ourselves up for this. We have very little debt on the balance sheet. We'll think we'll be around for quite a while. And we've got several other levers to pull. We've got other businesses that are literally worth more than the equity value of our company. So, look, it's just part of the game that we have to play, and it's part of the cyclicality of our industry.
All right, Todd, really good to talk to you. I have to get you back to see how all that's progressing. Todd Becker, Green Plains CEO, thank you very much. Well, coming up, it is yet a bullish chart for gold and a bearish one for the NASDAQ. That's coming up on today's Technically Speaking. This is Bloomberg.
What's up, everybody?
Time now for Technically Speaking. Joining me, Mike McGlone, a Bloomberg Intelligence commodity strategist. All right, so give me the bullish case for gold.
Hello, Alex. So you might be able to see in the chart, we have a triple high going in gold futures right now. As we speak, gold futures are at, if they close here, at a 7-year high. That's about $16.80 an ounce. And gold futures have really been the story because gold futures have been outpacing cash. I look at it as a former trader. When you get lifted out of your cash and you don't have inventory, you lift the futures, and that's really what's happening in the short term. So gold futures breaking out. I don't know really what's going to take to hold it down. Just look at the next resistance, probably around 1,700, and they think the all-time high is around 1,900 is probably a good target.
That can't be good, though, for the equity market.
Well, I think that's the opposite. So if I look
Might
over
have missed
NASDAQ,
this trade.
everything's
Sorry.
leaning on the NASDAQ. NASDAQ is kind of hovering above 7,000, above a trend line that's held since the election. And if you think about when's the next time we're going to see a full baseball stadium, it's probably going to be a long time. You have to be kind of bearish NASDAQ. So I think you're seeing a bounce right now, probably more of a dead cat. And again, it's only a few months from the old highs. So probably more of an enduring bear market, more likely to break support over there.
All right, Mike, really great to catch up with you on this Monday. Mike McGlone of Bloomberg Intelligence.
The new candle about the
me
phone.
here at Bloomberg Daybreak America is coming up on the Open with John Farrow, Ellen Wald, Atlantic Council Senior Fellow. Happy Monday, everybody. This is Bloomberg.
The new candle about the phone. So that's good. That's good. What time they got? 1,600. Let me add. Alright, so new candle just formed, 4-hour candle just formed. So now I can look at my trades again. So, this one in the blue, we in there, we in the clear on this one. I'm gonna ride this one out for a while. I like it. What's this look like? It look like it's trying to, remember what I told you it was gonna do? Wrap around and come back. I might just take my money out this one, DJ, right? So I ain't even got much in there. I'm gonna take a little bit of profit out that one, a little bit. Smile. I knew it was gonna do that. I was just saying that, hoping. It looked like it was so close to the line, man. I might just cut my loss here. That's fine. I'll take it. I think I can still get in this one. This one just on the daily. This one look good on the daily. I might hop in this. ECAD. Let me see. I know I'm a little late on the 4-hour and all that, but that daily look good. Damn, that daily look good. Let me see how many more hours left in the day. 16, 10. 8 more hours left. It's all good. I'll pass on that. This look real good. Let me see. missed that too.
From New York City for our audience worldwide, good morning, good morning. The countdown to the Open starts right now, 30 minutes away on this Monday morning. Here is your Monday morning price action. Equity futures are positive, up by 3.8% on the S&P 500. So far, so good. In the bond market, yields a little bit higher, the curve a little bit steeper, up by 5 basis points on 10s to 0.646%. In foreign exchange, euro dollar unmoved through much of this session, kind of where we are right now. And in the commodity market, we rebound off last night's lows on crude. We'll talk about that a little bit later. That's the price action of the morning so far. We begin with the top story. A little bit of hope, a little ray of light in Europe, and a sign that the mitigation efforts in places like Spain and Italy are starting to show some rewards, some success, and a hope here in the United States that their present is our future. We begin the program with that hope, then we can bring in Bloomberg's Michael McKee for more. Good morning to you, Mike.
Morning to you, John. Well, a lot of people have lost a lot of money because of this virus, and they don't want to lose it anymore, which is why you see this ray of hope on Wall Street, based on very little, but the possibility of light at the end of the tunnel. As you mentioned, we've seen a decline in death rates in Italy, Spain, Germany, and also the Netherlands 2 days in a row. We saw 1 day's decline in death rates in New York City, and that's all being taken as very good news. But remember, we're still seeing more people dying. We're still seeing more people getting the disease. It's just a drop in the growth rate, as Tom Keene would like to say, the second derivative. Global cases are near 1.3 million. There are over 70,000 deaths right now, and we're still seeing increasing infections and deaths in places like Detroit and New Orleans, other places in the United States. You've got things going on like in Georgia. The governor opened the beaches, and people are rather upset about that because they think it could just bring us back. But the question, if we do see an ongoing decline in death rates and in infections, is whether we've passed the peak. And once we've passed the peak, how quickly can you start opening up the economy again? Most analysts think it's going to take some time, and it's going to take time for people to believe they can actually get back to work. But after you've lost trillions of dollars, you grasp on to any ray of sunshine you can, John.
It seems to be the story this morning, that's for sure. Mike, stay close. We'll try and catch up with you a little bit later on the program. So many times on this show, on this program, we've talked about scope and severity. How bad would it get? How wide would this disease spread? We've also thought about duration, and I think duration continues to be the big unknown for this market right now. How long will big cities like the one I'm in right now, and I'm sure for many of you at home, the cities, the towns that you're in too, how long will they be shut down for? Let's bring in Ashok Bhatia, shall we? He joins us of Neuberger Berman. Ashok, great to get you with us on the program. Some signs of stability. How many times have you and I been told hope is not a strategy, but there's a bit of hope this morning? How do you process some of the data coming out of these hot spots like Italy, like Spain?
Yeah, hey, morning, Jonathan. I think, there's obviously some improvement in the data, but, our sense is the markets are, as you and Michael were talking about, in the next month or so, we are going to be shifting the discussion to how does the economy reopen. And I think the important conversation then will be, is the U.S. economy and the global economy, are we going back to 95% of peak levels in a lot of these categories like lodging and hospitality and retail trade, or are we going back to 80% of target? And that's something that is probably, in our sense, it's going to play out a little bit longer, and it's going to take longer to get back to the 100% levels of activity in these areas. And, the other thing that's going to be, I think, really important in this whole conversation as we migrate from virus to the recovery is the extent, there's a lot of estimates that GDP will be down 2 to 3 to 4% this year, but it does mask what's going to happen as a significant decline in private GDP that's going to be picked up by significant public sector GDP. So the contraction we're going to see in the private sector, which, obviously impacts our investments in credit, equities, et cetera, it's going to be more significant than what the overall GDP numbers look like, and that paints a picture of a longer recovery and probably a slower slog to get back to the levels that we were at.
Well, Ashok, let's talk about what it means for markets and for you specifically in fixed income, what it means for credit. There has been a huge up in quality trade going on over the last few weeks. A lot of people looking to buy high quality, high grade, investment grade US credit. And despite record weekly supply,
I hate
last week
when the market
spreads
moves like
actually
this.
tightened.
I'm just
They
not
narrowed.
a big fan of it.
We're absorbing that takedown of supply really quite well, Ashok. And a lot of people are thinking about this follow the Fed strategy. Is that what you've been doing, the up in quality, the high grade, high quality investment grade US companies in the debt market?
Yeah, I think, this is an occasion where, people say, don't go with consensus, but I think this is a case where consensus is right. The Fed is going to be buying agency mortgages. It's going to be buying investment-grade credit. I think, importantly, those programs for investment-grade credit and commercial paper, they're just starting to get stood up. The movements we've seen have been anticipation, in anticipation
I've been struggling with this trade for a while.
The Fed being in there.
But on the flip
it's gonna be a
side,
big
it still
support.
didn't pass this
if you're
line.
a
So
triple B company,
I mean, I
suddenly
still
the
got a
incentives
chance.
to remain investment grade, to have more cash on your balance sheet, to delever, those aren't going away. So I think you're going to see, improving credit trajectories for
This trade
investment
looks real
grade
good.
companies. You're going to see more interest if you're a strong double B
Oh,
plus.
yeah.
Suddenly the
I
advantages
like this
to being investment grade are
I
going
got
up.
him right here.
And so what the market has been doing in buying agency mortgages, increasing investment grade credit, those are things we've been doing and think they've got more room to run. If you just look at banks, financial bank credit, 250 basis points over treasuries. Before this all started, we were about 100 over. Treasuries are a little bit below that. This is not an environment where the U.S. government's going to let the U.S. banks default, and that's going to be an area when the market settles in and realizes we're at 0% rates for years. That type of high-quality carry is going to be back in demand and in vogue, and I think possibly sooner than maybe the market, than people anticipate.
Let's explore that further, Ashok, because at the moment there is a consensus trade on. We're discussing it right now. There's a consensus view, though, that the central bank stimulus that we have at the moment is different to the stimulus we've had before. Typically, when a central bank stepped in, the stimulus would bleed through and beyond just the asset class it was buying in. Example of that, say Europe, the ECB buys investment-grade credit, but the impact of that spills over to high yield and spreads tighten there. But in this environment, there's a belief that you either have direct access to the drawbridge, the liquidity, the debt markets, the high-grade portion, or you don't.
I like it.
And the bifurcation that we're about to experience between the haves and have-nots
This
is going
downtrend is
to
real
increase.
healthy. I'm going to keep this
Do
in
you
there
take
for
the
a
other
while.
side of that, Ashok, or is that something you're thinking about too?
No, I think I agree with that for right now, and I'd make two quick points. One is, at these spread levels, you'd have to compress investment grade and mortgage spreads, another significant wave before I think you'll bribe people, to come back into high yield credit and do those types of swaps. I mean, people want high quality income after the experience we've had. And we're not at levels where it's, so rich that investors will want to exit it. The second thing I'll say, though, is that, a lot of double B plus high yield, we think is going to be on an improving credit trajectory the next few years as they take actions of, reduced stock buybacks and things like that. And so I think, high yield, there's, it spreads at 950 basis points over. There's a lot of default risk priced in there. So we think high yield can perform, but I think we're not at the level, like you said, where it's going to just quickly bleed into that market until investment grade and mortgage spread levels tighten, I think, significantly.
But Ashok, what you just said about credit is really important for the equity investor as well. It's a theme that's come up on this program several times over the last several weeks. We typically think about credit leading equity, but in the environment you describe, that's a credit that's doing better because they're right-sizing balance sheets and stopping the things that benefit the equities, the shareholders, the things like buybacks, etc. And I'm trying to get my hands around a world where maybe the types of credits improve, the ones that you describe, but the benefits don't spill over to equity. Are you having conversations at Neuberger right now about those kind of themes?
We are, and I think the answer is we're not sure. There's a couple of examples, right? After 2008 and 2015, 2016, and talk about 15 and 16 briefly in the energy sector. energy companies that did bondholder-friendly things to improve their balance sheet actually saw rising stock prices. And, we have an example of, and this was before this all happened, Kraft Heinz, makes a decision to go to high yield, and stock doesn't react favorably to that. So I think it's an open question of whether or not some of the things we think happen on the credit side do actually benefit the equities, because that's what the equity market is going to ascribe. The equity market will end up ascribing a higher multiple to stronger balance sheets, more liquidity, these types of things. And there is precedence after 08 and 15 and 16 for the equity market to reward those kind of things. But so I think the argument that being bondholder friendly in this environment is necessarily an equity negative. Not convinced of that.
Ashok Badia, appreciate your time this morning. Really thoughtful stuff of Neuberger Berman there, weighing in on the credit market and what it means for your equity market possibly as well. Next up on the programme, we'll take it to the commodity market and get you up to speed on what on earth is happening in the politics of crude oil. We were meant to have an OPEC Plus meeting today. I understand it will now take place on Thursday. Next up on the show, we'll get the view of Ellen Wald of the Atlantic Council, a conversation you don't want to miss on the commodity market as we bounce off the lows overnight. Equity futures looking good, 20 minutes away from the opening bell this morning. Good morning, this is Bloomberg TV.
This is getting quite difficult on a political level, and that's why, they had to delay the meeting from today to Thursday, but we have been told that unless and until there is a breakthrough through the back channel talks, there may not be talks. And in any case, I think it's important to point out, no amount of cuts is going to be enough to offset the lower demand, because they're talking about 10. The reality is demand is probably down by 25 million barrels per day.
Amrita Sen there of Energy Aspects weighing in on the oil market. Looking at the oil market this morning, we are off the lows. We are still lower, $27 a barrel on WTI. A big focus now on Thursday and the meeting of OPEC Plus. You have to ask yourself a basic question at the moment, though. Are we closer to some kind of deal than we were a week ago? The answer to that question is undoubtedly yes, because a week ago, I think many people out there didn't think we were going to get any kind of a deal anytime soon.
What up, Ron?
So weighing on this situation,
how's it cooking, bro? What's up, bro?
Of the Atlantic Council.
It's looking good, man.
One key question
what are
I
you
have
feeling
at the moment
today? What's
about
up, Ron?
the
With
prospect
it?
of a deal between OPEC Plus is U.S.
I'm in a couple trades right
participation,
now.
because when you listen to Russia over the last several days, there has
I'm
been a
in
pretty
GJ,
constant call
still in the
for the U.S. to
consolidation.
participate. And I'm trying to understand
Waiting on
how
it
the
to
United
break
States
out.
participates
On the flip side,
in a
it
round
tapped
of
that line
supply
again and
cuts
came back
agreed
down.
over at OPEC Plus.
So, of course, I'm in the negative, but that's not a bad
That's
sign,
exactly
though.
the question
So, I'm
that
okay
is
with
on
that negative.
everyone's mind. And the real answer
I'm in
to
the negative
this is
for
that
now.
the U.S. participates in as much as the
This
free
one,
market allows it to participate. So
patiently waiting.
there is
Wanted to break out again.
really
It's all
no
good.
effective way for the United States
GBP
to
New Zealand dollars.
participate in
This one's
a
paying me
no
right now,
carbon
so I'm
production
good here.
cut deal, mostly because there is no way
This one's
for the
paying me.
United States
Matter of
to
fact,
regulate
Ron, you still
oil
there, bro?
production on a national
This was the trade that me and
level.
you,
There just
well,
isn't a
not me and you,
mechanism for
but
this.
when me
In
and you was
order
talking
to do
yesterday,
this,
this is the
we
trade I
need
got
to
in
pass a
yesterday.
law through Congress that gives
Remember the
the
one?
Department
I was
the
like, oh, I think I'm about
ability
to hop in this
regulate
one before
this.
you went to bed.
There are a couple of ways that they could kind of get around that, possibly through enforcing flaring regulations.
I'm up 161 pips.
Possibly by enforcing some kind
You know what I
of
mean?
public health issue on drilling in the Gulf of
I just
Mexico.
came
But
back.
these
Oh, I
would
was
all
just
be
talking to you.
challenged
I was saying,
because it's
well, I'll
clear
show you the
that
trades I'm in
this is
again.
being
Matter of
done
fact,
to
then,
regulate
since you just
production,
came
not
back.
for the intent.
All right, so I'm in
It's pretty clear
GJ.
that at least
I'm still in the
Exxon,
consolidation
is not
zone, but it's not
interested
that bad
in going along with any
because it,
cuts, and
you know,
we're
remember
challenging
it tapped
this
that line
court.
a couple times.
It's really hard to
So
see
that's
a way for
cool.
the U.S. to participate
If
other
it breaks
than
down, I'm in
natural
gravy, right? I'm
market
gonna be in
forces
gravy for
causing
sure
a
because I got
decline in
a
production
0.8 lot
at this
size on
point.
this one.
And that could crater these talks.
This one right here. This was on an uptrend. Now it's moving sideways. So this one might be in the consolidation for a minute, for a while too,
or
at least
the
I
very
think.
least participation
Then
of
probably break
Canada,
down.
Norway, countries that weren't in the
GBP New
original
Zealand
OPEC
dollars.
Plus
This is the one.
group
Remember
to
when
get
I was
on
talking to you in
board.
Discord yesterday? This was the trade I got in before I went to
Alan, I'm going to
bed.
jump in
You
because the
know,
line
it
on
was
my
when you went
side
to
is really
bed.
quite
Remember?
bad. Adam
And I think me and you got. Well, I mean you, but I got in right here.
On the commodity market and
I'm
OPEC
already
Plus,
up
nevertheless.
160.
The
Well, past that
situation's really
now.
quite depressed at the
But
front end of the curve.
imagine,
Take a look
imagine waking up
at
to
the
161
crude curve
pips.
right now, just the futures
Come on,
curve.
bro.
Very, very depressed
Stop.
at the front end of the curve, and it drifts higher,
Stop it.
aggressively higher further out. And you ask a
161
lot of people
pips.
why that situation looks
I
the
got
way
a
it does in the oil market and oil
0.02
pricing
lot
right
size
now.
on this one though. It's a small lot
The
size,
example
but
they will give you is not
it's
one
all
of
good.
oversupply.
We'll get there
It's a
eventually.
lack of demand. And the big
This
lift,
one I just got
the
in,
big,
so of
big,
course you know
big
how it goes. You
question
start off
on
negative. then you
Thursday
go
is whether
from
they
there.
can cut supply enough to offset the massive collapse in demand that we've actually had.
So the
And
4 hour
answer
just
to
hit
that
again.
is probably no.
The new
So
4 hour
this
just
market will
hit.
stay
So right now I'm just
oversupplied.
looking for another
So the
4
things
hour
you've got to
trade to
think
go
about
in.
right now is how close are we to breaching storage capacity in several key oil markets? And if they can do something on the supply side, sure, it helps. But if you continue to be oversupplied, do you tip over the edge in storage capacity
This
a
one
little
look
bit, which
good.
is why a lot
I like
of
to get
people
it
are
at the
going to
red
continue
though.
to be on
The
the
blue
back
is
foot,
real good
even
though.
as
They
crude
say,
jumped quite
but I like to
aggressively
get it
last week
early
because of what is happening on
so I
the
can ride the whole
physical
thing
side,
out.
not what's happening in the paper markets on the back of the huge short squeeze we saw last week, but on the physical side of things, where in the spot price,
I've never
things
invested
are
in the
very,
Forex.
very
Man,
still,
I've only been
very,
in for
very
like
oversupplied.
maybe like
And to
5-6
clear
weeks.
that demand and supply, you've
So,
needed a
you know,
much
it's worth
lower
it for
crude
me.
price. A theme we'll explore through much of this week, I'm sure. Up next on this program, we'll talk about the economy and we'll talk about the Treasury market too with Subhadra Rajappa of SocGen. From New York this morning, good morning. Equity
This one
futures
looks
nice and
okay.
positive. This is Bloomberg.
The 30 minute don't look too good, and the daily don't look good either. So if I get in this one, it'll be temporary. See, that's the thing. That's why I say when I look at the daily, because like the 4 hour look like it's gonna go up, but the daily look like it's gonna go down, which means I can only maybe I'll only finish this candle up, take out, or I might, you know what I mean? Because it's just, you know, when the daily says down, the 4 hour says up. Kind of just gotta. If you don't get in early, then you just don't get in at all. I buy longer plays, 1,000 shares of Ayana for 6.4 on Friday. I got a couple of shares and I sold a couple of shares, but I'm waiting. You know, they said this next 2 weeks gonna be crazy with this COVID-19, so. You know, I'm just waiting it out. Let's see what we got. You say I hit you. I just hit you with the account picture. What you talking about? I might get in this. This look like it's gonna keep coming down. So at least I might not wait for this one. Let me see. I'm late to the party though, unfortunately, but that daily look kind of good, so I might just. What's this one? You care, right? I don't know. I'm late to the party though, but it looks so perfect. I'm getting there.
10 minutes away from the opening bell in New York City this morning. Good morning to you all. It's time to get you the morning calls, the analyst action on Wall Street this morning. Not much on Wall Street, I know. So many people have told me that already.
The daily
analyst
looks
action
sexy.
from the home office of many people on Wall
Before,
Street right now. Let's begin
you can
first
tell
up
I
with
missed
Raymond
the boat.
James upgrading
Daily
Intel
look
to
good.
market perform from underperform, writing that the chip maker could see indirect tailwinds from the
know.
coronavirus
There's so
outbreak.
much more
Next
hours
up,
left in the
Jeffries
day.
upgrading Tesla to a buy with a 650 price
only
target,
8 hours left in
expecting
the day,
earnings
though,
and free
man.
cash flow to be supported by better productivity and stable selling prices. And finally, Guggenheim upgrading eBay to a buy with a $36 price target. The analyst seeing a more favorable risk
I'll
reward
take the
following
risk.
the stock's 20% pullback from its March highs. There's some of the calls from the street. Let's talk about the
I'll
data
stop
now,
by
where
right
things
there.
still are very uncertain. What have we learned from the data?
That's not bad. That's
in the
$12
last
stop
week?
loss.
I think
I'll
to
take
make it
that any
simple,
day.
things were bad before the
That's worth it for
shutdown.
me.
They're bad during the shutdown. You can see that in the payrolls numbers that
That's
feel stale,
definitely
but were
worth it
still
for
negative
me.
going into the economic shutdown in many big cities.
And
you see it in the initial
Discord.
jobless claims, which have
All right, give
been
me a second.
absolutely brutal, ugly, terrible amidst this shutdown. Here's the question for me, though. What else does it tell you? For me, it tells you that economists are still struggling to understand the depths of the slowdown going into the huge mitigation effort and the depths of the slowdown right here, right now. And you can see that just in the range of estimates at the moment. Going into payrolls last
Damn.
week, we
All
had
right,
a range of
let's do it.
estimates and a
Entry
median
price.
estimate of
What's
negative
this?
100K.
Okay.
It
Oh,
was
this is
much,
50.
much worse than that. We saw this again with initial jobless claims. The range of estimates anywhere from 800,000 to 6 million. And the initial jobless claims print came out right at the top end of the range of estimates. So why are we finding it
Wait,
so
is that right?
difficult to understand the moment we were in going into the shutdown and the moment we're in right now? Let's bring in Subhadra Rajapra of SocGen, shall we, to talk about it just a little bit more. Subhadra, this has been a focus for me just over the last couple of days. We lack visibility about the future, but also seemingly we lack a lot of visibility about the present and the recent past. Why are we finding it so difficult to understand the depths of the slowdown going into the shutdown, lockdown of cities like New York and the depth of the slowdown that we're in right now, Subhadra?
Well, the employment numbers are very, very hard to gauge, right? Because you're looking at a workforce that's 150
I'm gonna have my
million
take
in
profit set
size,
to
and these are very
5,
unprecedented
2.
times. So you should expect some volatility.
Actually,
I think
typed that in
part of
wrong.
the reason for some of the underestimation was
4,
people,
6,
especially
1,
economists,
0.
weren't really expecting,
Stop
the
level.
local governments to be up and ready to be able to take in that many claims in a very short
Look
period
at
of
that
time.
stop. That's a
So this is very much to
wait.
be
Let me make sure I
expected.
type that
think
in right.
that we've just never been in a situation like this. So the question really is, once we get past the near term, what our expectations should be for the
There we
longer
go.
term, and that's really where we need to focus on for the most part.
I love short. When you have a short
To get a
stop
better
loss
idea of the
like this,
future, we need a better
that means you're in
understanding
the
of how
clear,
the fiscal
bro.
stimulus
That's all
effort
that means.
in this very moment
Like I got a
is hitting
$12
its
stop
target. The
loss
small
to make
business
about a
lending
couple $100
program
bucks.
started on Friday. I just wonder,
I might even
yourself,
stay in it.
Subhadra,
Let me
the
see
team
how I got
over
my.
at SocGen, how closely
Like I
you're
got my
watching
thing right here.
the
I might
rollout
can
of
ride
that
that thing out to at
and
least
how
right
you're
here.
gauging how
But
well
we're gonna
it's
see.
doing in the early days,
We're gonna
granted,
see.
but whether this fiscal plan
Mark
can
this
hit
up
its
right
target
here.
and hit it quickly.
But the daily look good, and they ain't
Well,
even past
it should. I think it's very
blue
much in
yet.
its early
So
stages. You're
mark
seeing some
that.
of the other Fed programs that were instituted in the last couple of weeks actually coming live and having a meaningful impact on the broader liquidity conditions in treasuries, for instance. So I think it's too early to have a very specific comment on the small business program.
That look
But
good,
the
bro. That
expectation
don't
is
look so.
that
That's a
it
healthy
should start
downtrend. I
providing
love
the
it.
stimulus that the
All right, my
market
man said I sent
participants
you a.
need.
I hit you
Also,
with the
the
account
checks
picture.
that
I'm pulling it
start
up in
rolling in for individuals as well as families. I think that should
my
go a
other
long
laptop.
way in
Let's see what you got
supporting
here.
some of the near-term constraints due to lack of employment.
There aren't many things we know for sure, but one of the things we know for sure in this environment is that we're going to have
see
more
you,
debt,
man.
and
It's
there's going to be more
the
supply
it's the
from
TD
the Treasury.
Ameritrade, right?
How do you expect us to take down that supply in this environment? How do you expect price to respond in Treasury markets?
Oh,
in the
I
coming
see
weeks
what
and
you got.
months?
I see what you're doing.
Well, that's
I
a
kind of
risk,
like
right? On one side, you
my.
have the
I
Treasury
mean,
buying.
I'm
has
using
already bought over. Sorry, a Fed already
Merrill
bought
Lynch for
over
my
$1 trillion
stocks. I don't
worth
buy stocks.
of Treasuries.
No. I use
And then on the
Merrill
other
Lynch
hand, you
for
have
my stocks. I buy
tremendous amount
stocks with Merrill Lynch,
of debt
but I
across the
also
curve. I
trade
mean, last
stocks.
week,
Like if you
the
pull this
Treasury
up,
surprised the markets by announcing a large
I don't do it often,
coupon
but
issuance
sometimes I
for the
do.
3-year, 10-year, and
Like this is
30-year
the
options
S&P
this
index,
week.
the Dow
There's also going
Jones,
to be a
crude
tremendous amount
oil,
of front-end
gold,
supply of
silver,
bills.
cryptocurrencies like
So I think
Bitcoin,
that it's
dollar
my
index,
concern is
Apple,
really that
Amazon,
the
Boeing,
tails in this environment are quite
eBay,
fat in the sense that
Facebook, Ford,
on
General
one hand,
Motors,
if the
Apple,
economy
stuff
does
like that.
improve, we
Now
could
I
see
do
a
buy them
quick
stocks
snapback
now.
in yields towards higher yields as
This
the
one look
market
good
has
right
to take
here.
down a bunch of supply. So that to me is definitely
Man,
a
once this
concern.
thing
But
right here
Nasdaq
just
has
break
been
out, like
experiencing
stop. Just give
quite a
me
lot of
my money,
trending. The
man.
question is, what
Once
is
this
their
one
end
right here
game for
break
the long
out,
run?
we
Are they going to
in
have to,
the clear, my
potentially use
dog. I'm talking about we
yield
in the
curve
clear.
control or other measures to sort of slow down
But
their pace of
I
asset
gotta ride out the
purchases,
negative wave
or
for a
are they
bit.
going to
So
continue to support the Treasury market by
I slowly
buying
but
Treasuries
surely
to
built
weaken the
my account
market?
up
And
so I
that's
can hold
really
up on
the
the
concern
drawdowns. You know what I
right now.
mean?
As
Because
long
like
as
when
the
you
Fed
up
is
here, that
buying
thing say
Treasuries, I
negative
think that there should
60.
be
You got to be able to
a
hold
relatively
that negative
higher
60 until it come
for the
back down.
additional supply that's
Because
hitting the market.
if you can't afford that
Treasury
drawdown,
Zappa,
that's a
Stock
wrap.
So many things we need to
I
get
ran
our
that
hands
account
around
up
that we'll
from
continue to do so
$200.
with you in the coming weeks,
When?
I'm sure, including why some people are backing away from treasuries and thinking that maybe the risk mitigating characteristics of those particular securities have diminished somewhat given the levels we're at over the last couple of weeks. More on that perhaps a little bit later this morning or later in this week. At the moment, equity futures doing better than good. Equity futures positive going into the opening bow from New York this morning. Good morning from New York. This is Bloomberg TV.
You talking about from stocks or trader? Oh, pass it. Nah, I was in the clear too on a couple of my stocks, and then I just took it out like right before this stuff happened. Well, I mean, not right before it happened, but like when it happened, it was, like I think when I got in the Apple, I got in the Apple at like 160, and it shot up to like $300. And then when this stuff happened, I pulled out at like 270 something or 280 something. So I was still in a profit. And then I bought some in the Carnival Cruise Line when it dropped to $9 and it shot up to 15. Took my bread out there. You know what I mean? Like, so right now I got a buy limit on Carnival Cruise Line. See, I bought some right here. I got some Carnival. I still bought some more at $10.95. But I still want it to go down. But if it go down to $3, then I'm gonna buy some more. I mean, if it go up, cool. I'm in the green. You know what I mean? But if it go down, I'm gonna make it green. Hey, that's some good stuff, man. You gotta let me know what you be trading on them options, man. You can't be greedy, man. I'm sharing the info to you and your boy. You can't be greedy with the bread now. You can't be the only one eating. Hey, it's like the Last Supper, you know what I'm talking about? We all got to eat at the same table. This one look good now. I like it. Let's see how I look on the daily. When are they over? 8 more hours, right? Okay. So if this daily shows that it still wants to come back into that red, that means I can hold this trade for another 2-3 days, bro. Damn, I wish I hit more in there, but it's all good. It'd be happening like that. I got over 10K hours in this, bro. So you should be able to go mid then. I know anybody else who watching this stream might not get that joke. It's okay though. Oh, I forgot let me turn my chat on. I don't think my chat is on. My chat on? Okay, it's on.
From New York City this morning, good morning. Around about 21 seconds away from the opening bell in New York. Let's get you up to speed on some of the price action, shall we? With equity futures nicely positive going into this open. We were down through last week, down around about 2 percentage points on the S&P 500 through the week. Higher at the open yesterday, and that's where we stayed through much of this morning. In the bond market, Treasury yields come up by 6 basis points.
Just crossed on a daily.
0.659%.
When
The
it
distance
like
between 2s and 10s
daily,
stretches a little bit wider, the curve a little bit steeper. I have to say, no big moves in price action in G10 for the US dollar so far. Euro dollar really quite stable. Outside of that, in the commodity market, a story as follows.
Oh, the market is open, didn't
Crude
it?
bouncing off the lows of yesterday evening, still lower though. We're down by 4.4% on WTI to $27 and around about 10 cents. Let's get to the market desk, shall we, and get you up to speed on some of the price action elsewhere. It's Taylor Riggs.
John, yes, so as you mentioned, the S&P 500 doing pretty well today. This is after they had a really strong last Monday as well, when they were also up about 3.4%. Before that, you haven't had a positive Monday going back until March 2nd.
See how they do your
now up almost 14%.
See, they don't want a brother to eat. I just had money. I broke that quick.
Because the S&P is still
they
down
don't want
about
me to eat, bro.
27% from the record highs that we had back in February. Let's take a look at some of the individual movers.
I was like, damn, I'm paid right now.
Even after they extended the shutdown of their Seattle area production facility, all of course on virus worries. Zoom Communications are getting a downgrade by Credit Suisse to underperform from neutral. They're saying that the surge in users could be short-lived. That's why, in part, that company's off about 13% this morning. Hilton, they're bouncing back after 6 straight losses. Travel stocks are mostly up today.
Hey, I ain't falling for these bounce ups.
Just a little bit, but Hilton
I ain't
getting
falling for the
boost
okie doke. It's going to keep dropping.
Finally, take a look at SeaWorld. They just continue to struggle, but today higher up by 9%. This is after the CEO is resigning effective immediately, leaving his position, John, after only 5 months on the job. There have been 7 CEOs at SeaWorld since January of 2015. This is after the already troubled theme park operator now has to contend with the coronavirus crisis. But at least this morning, analysts and investors liking the shakeup that they're seeing within the ranks. John.
Taylor Riggs there with the latest from the market desk. Taylor, thank you.
Bro, by the time we didn't make all this bread.
Schroders. John, fantastic to get you with us on the program.
And this coronavirus stuff over with, bro.
We started on this program.
We got to take a trip to Cali, bro.
The hope there, the stability that we see perhaps in places like Europe.
That's what Kimchi and Akbar and them boys at. We got to go act out with them.
And I hope that we're seeing some signs that the mitigation efforts are working. And I'll repeat something I said at the top of the show. I hope that their presence is perhaps our future, that we'll come out the other side of this, and hopefully we will come out of the other side of this with a better future and some optimism about what
the back half of this year holds. John, I want you to put in perspective just a little bit of context, how we should be thinking about and try to come back up, and then just now I'm about to catch that downtrend, baby.
Yeah, thanks, John, for having me, and I'll give you kudos for having the best backdrop in the TV business right now, the financial TV business right now.
California.
I've got to say, for the first time in 7 weeks, I woke up this morning feeling a little bit more optimistic about risk assets in general. It does not mean that we can't retest the lows we saw on March 23rd. But I think the way we've been
nice and
framing
healthy
this
right there. What time is it?
Look
35?
at 3 signposts. One is the support of fiscal monetary stimulus, which we've got in spades, and much more than we did in prior crises, and much more sudden.
Let that roll out.
And then some sign that the virus was starting to peak, the number of cases, the mortality rate was starting to peak. And I'm obviously not an expert, and I know, you've got a lot of people saying that right now in the financial business, but the way I think about it is every day that we go through this crisis, you get medical experts, people that know what they're doing, immunologists, et cetera, getting one step closer to a better way to treat it and contain it. And I think that's what we continue to see within, within that field.
One of the things that I think we can focus on the market side, John, is trying to understand
on a
the
4-hour
regime
chart, and it definitely was good on the
regime we're working our way
I'm
into.
excited about this trade.
You and I have talked about this for years now. This was a bond market that just funded the hopes and dreams of equities. 4 years. In fact, you had a C-suite that was basically incentivized to turn up the leverage and run a triple B balance sheet to fund the big buybacks elsewhere because the incremental interest rate cost of doing that was so low. That story, John, has shifted and shifted quite quickly. Feels like the credit market's in the driving seat. And the hopes and dreams of equity investors will remain in the backseat and rearview mirror for quite a while. And there's some big calls about what that could mean for buybacks, for dividends, for this equity market. This is from Goldman Sachs. They see S&P 500 firms prioritizing liquidity in 2020, leading to a 25% fall in dividends and a 50% drop in buybacks. John, and I'm trying to understand, yes, we've had a big drawdown, but have we priced in just how bad things are going to get in the coming months outside of the pandemic, around the earnings backdrop, around the buybacks
and struggle to pass this line,
around future dividends as well?
So I'd be a fool to think that I can call the exact bottom, right? And all those reasons you cited are reasons to continue to be concerned about global equities. And I think you're right to say, and I've seen a lot of people talking about this, that the regime will shift and that we'll move back towards a more fundamental.
I'm about to say, why am I in this trade? I was just looking at that. I was like, what made me do this? Then I realized this is something I just
strong free cash flows, low levels of relative debt.
I'm about to say, I can't be that crazy, but I kind of want to get in this trade now.
Back in 08, 09,
4-hour chart. I'm gonna wait to the next 4 hour.
Dividends being cut, buybacks being cut. We went into an extremely low rate environment, which allowed companies to take on debt and increase those levels of dividend buybacks. Sort of financials being the epicenter of
now
that.
I like to look to see which trades I'm in profit in.
And I'd be willing to bet that shifts in this environment to other sectors of the economy. Obviously, sectors that have been hit the hardest by this, the travel and leisure sector and the energy sector as well. But those are small pieces of the dividend and share buyback, piece of the S&P 500. So I think that goes down a little bit, and you go back to an environment where fundamentals matter more, which probably means the upside potential from here is more limited than it was when we came out of 08, 09, and certainly than when we came out of 01, 02. But it doesn't mean that buybacks and dividend increases go away permanently. Jamie Dimon actually came out in his investor newsletter and said that they would.
Oh wait, it's not news. This is news right here. So this is the most important part of the day. When you guys survive the drawdowns, because it's going to shoot up and down.
Those will still matter, but just less than they have in the past.
Well, John, let's read out that Jamie Dimon quote, shall we, from that 23-page letter, I think. This was the quote that stood out for many people. At a minimum, we assumed that it would include a bad recession combined with some kind of financial stress similar to the global financial crisis of 2008. Now, that sounds really, really bad. But to your point, clearly not bad enough to cut the dividend, though, because he said any such move would only result from extreme prudence. So, John, with that in mind, have we really priced in how bad this could be? Because there is someone at the top of a bank reflecting on parallels to 2008, but conceding they're not going to cut the dividend. That seems to me, watch what I do, not what I say.
Yeah, I couldn't agree more. So, again, getting back to my point about I don't know if March 23rd was the exact bottom, but I think the big difference this time is when we went through 08, 09, and I've seen actually people drawing comparisons, this could be like the Great Depression, which I strongly, strongly disagree with, is you have light at the end of the tunnel. We know that within 1 year, maybe 18 months, we'll have a vaccine, and that once we get that, people can go out and confidently do what they used to do, spend money as a consumer, run your business, bring people to work, make goods and services, and know that there will be demand for them. That seems like a long way off, but I think that in the meantime, each day that goes by, we'll get more and more used to living with this virus. Again, getting back to my earlier point about the medical profession working vigorously and expeditiously to try and find something that will allow us to treat it, live with it, maybe manage it, antibodies, immunity passports, things like that. And you've got the federal, fiscal, and monetary response, which is like nothing we've ever seen before in terms of the scale of it and the speed with which it happens. So I'm not suggesting things are good. I'm certainly not suggesting that we won't go through a period of pretty awful earnings as well as credit downgrades and defaults. We will. But I think it's very different than what we went through in 08, 09, and certainly nothing close to what some people are saying could be the next Great Depression.
Well, guess what I'm saying, John, is that it's too early. It's too early to know. It's too early to know any of those things. And I take granted from what we know right now, maybe you can make those kind of calls. But that base case could shift quite quickly. It's too early to know the damage done to balance sheets. Too early to know whether this fiscal stimulus package will actually hit its target right now. We see the architect's plans, but the rollout only really started on Friday with the SME plan here in the United States. John, with that in mind, would you still preach patience in a market like this?
Yeah. So I think to your point, there's still plenty of unknowns. So it's not a jump off the diving board head first into the pool. It's dip your toe in the pool, right? We were down 34% peak trough in the S&P 500. Some markets around the world were down worse than that. Spain and Italy certainly took more pain. And there's plenty of stocks that fell significantly more than the index did. So what I would suggest doing is you look at your current holdings. If you can take a tax loss, you take that tax loss and you start dipping your toe back in the pool, because the bottoming process, as you know quite well, can take some time. I just think that there's value has been created, and there's policy supports in place, plus some light at the end of the tunnel on the virus, which should allow you to start taking on risk.
John Mackay of Schroders will talk about where to take that risk in the coming weeks. Always enjoy catching up with you. My best to you and yours and the team over at Schroders as well. The market right now, 10 minutes, 30 seconds into this session, equity markets are higher by 3.73% on the S&P 500. Next up on the programme, we'll talk about a specific sector, one that's really been quite hard hit by all of this, retail. We'll do that with Chuck Grom of Gordon Haskett. We'll do that next right here on The Open from New York. This is Bloomberg.
This is Bloomberg The Open. I'm Taylor Riggs, and coming up, the DoorDash CEO.
Let's get you the price action 13 minutes into the session. Here's your equity market, positive by 3.86% on the S&P 500. On the Nasdaq, up by 3.7%. A bounce back from last week's losses. I know that we have to get used to the fact that you shouldn't really attribute any given fundamental narrative to any market move in this environment, that things can change in 5 minutes and you can look very, very silly. But there is a bit more hope out there this morning, and that's underlying just a bit of a bounce in this equity market. Let's get to the market desk, shall we, and get you an update on the price action on the sector level, shall we? Let's get to Taylor Riggs. Hey, Taylor.
John, some of that hope is filtering through on a sector level, as you mentioned. Some of the more cyclical industries are the ones that are outperforming. Materials, financials, industrials, those are all up more than 5% or so. And some of the defensive sectors are the ones that are leading on the downside, though they are still green. The staples, for example, healthcare, some of the discretionary stocks. So every sector, at least for now, in the green, really highlighting a lot of that hope and optimism that you were referencing to. Speaking of sort of a lack of hope and optimism, I wanted to do a check on the retail sector. After the massive market rout that we've had, some of the smallest companies in market cap in the S&P 500 are in the retail sector. Last week, we know that Macy's was removed from the S&P 500 due to a drop in their market value. 13 now companies ended last week with a lower market value than most of the other components in the mid-cap 400 index. 3 of Macy's retail peers fall in that category. It's Gap, Kohl's, and Nordstrom's also on that list, John. Capri, Harley-Davidson, and Hanes Brand. So retail sector, John, still very much in trouble here.
That's Taylor Riggs there with the update in the markets from a sector level. Taylor, thank you. I'll pick up on retail. Something that stuck with me over the last week is a quote from Jim Bianco of Bianco Research, who wrote the following: "We're transitioning from a pre-virus economy to a post-virus economy, and we don't know what that's going to be. Don't think of this as some sort of mean reversion." I wonder what that means for a whole host of sectors, including retail, which has been absolutely battered by all of this. And I'm pleased to say that joining us on the phone is Chuck Grom of Gordon Haskett. Great to have you with us, Chuck. Let's get those thoughts from you.
Morning.
How you think retail is transitioning in this moment, out the other side, what this backdrop, this sector will look like?
I think you can look back to 2008 and 2009 and see how the consumer came out of that period. Very value-focused, price-focused, convenience-focused. And we've seen a number of retailers do very strong post that environment. You look at the dollar stores, you can look at the warehouse clubs, you can look at the off-price retailers. So I think, there's a little bit of a playbook for what is going on now and what's going to happen over the next 6 to, say, 24 months. It is going to be interesting, though, with social distancing, how people sort of handicap, going to restaurants, going to malls. And my sense is people start to push more online, and we've seen that over the past month based on our survey work. But to your point, the world's definitely going to change going forward.
Chuck, who do you think is transitioning well at the moment?
Well, I think, online grocery is really proliferated here over the past month. It's been a success point for Walmart and Target for a good period of time. But our survey work has shown that a lot more consumers are adopting to that. So I'd say Walmart and Target are doing very well. We also think the warehouse clubs will do particularly strong coming out of this period in terms of new member signups. So those would be a couple names that we think are doing very well.
Got a couple of playbooks, the likes of China, unfortunate, tragic playbooks at that, but still things we can learn from. Some people looking to the experience of, say, Nike over the last several months in a place like China with an e-commerce platform and wondering whether that's the playbook that some retailers could see play out in the coming weeks and months in places like the United States and elsewhere in Europe too. Do you see the parallels there at all, Chuck, the success of Nike in a place like China on the e-commerce side that could be replicated in places, in an environment like the one we're in right now in the United States?
I think, we'll cover Nike particularly, but I think the playbook of having physical and a digital presence are really important. And I think we've seen that play out here over the past few weeks. And even today with Wayfair updating their numbers, you're seeing a huge surge in spending in the home. So I think one of the things that's going to happen here going forward is where people spend. Clearly, big-ticket items are going to be under stress. Vacations, air travel, is going to be restricted. I think the theme of investing in the home is probably one of the things that we've been watching most closely.
Chuck, one thing I've been trying to understand, and I want to wrap it up here with you, because hopefully you can give me some clarity, is just make it really, really simple. Who's been unable to pay the rent, pay the bills in this environment? There was so much weakness in retail coming into this that I imagine that for the weaker names, this is just life ending for them at the corporate level. Chuck, which names right now do you pick out that you think there's some real stress and that perhaps we won't see these companies exist coming out the other side?
Well, I think first and foremost, I don't think we want that to happen. So I don't want to go on record predicting it. But I do think, to your point, there's, the simple math is if you're not open, you're burning cash. And the companies that aren't burning, that are burning cash today and under most duress would probably be the department stores, Kohl's, Macy's, Nordstrom, and JCPenney. The balance sheets for Kohl's in particular is very strong. But at the end of the day, we don't really want to see that happen, and we'll have to monitor how long these stores are going to be closed. Currently, it looks like at the end of April. We think probably could go into May, potentially June. Those are the names are probably of most concern. But again, obviously, we don't want to see that happen. There's lives at stake, and so on. So we'll see how it plays out.
None of us want to see that happen, but the discipline of markets is going to shake out some of the weakness. Going into this shutdown, what we did see was a debt market that was just readily available to support loss-making businesses, particularly startups, particularly from the tech world. Chuck, does any of that play out in retail for you, where there are areas of the market, startups that look like they were the next best thing, that were supported by easy money that's just not going to be there in the coming months, perhaps the coming years as well?
Yeah, well, I think, to your point, the consumer, certainly found the weak points in the fourth quarter. I think some of the names that we saw do very well, some of the digitally native brands that have been out there and proliferated. It'll be interesting to see how those companies come out on the other end. Again, I fall back on Wayfair, which today had a phenomenal number this morning as part of their 1Q update. But I think those digitally native brands are probably the ones that, were sort of accelerated towards over the past couple of years.
Chuck Grom, always appreciate your thoughts, his thoughts on retail. Next up, Stuart Kaiser of UBS, a final thought on this program about the path ahead and whether we're seeing things stabilize in volatility. That's next from New York. This is Bloomberg. Time now for the trading diary, the things you need to be watching in the days ahead. A holiday shortened week here in the United States and mostly worldwide across Europe as well. Let's get you some of the highlights. Today, we're looking at 5 p.m. Eastern, the White House holding its daily update on the coronavirus. On Tuesday, EU finance ministers meeting to discuss a pandemic response. The Fed releasing minutes from its March meeting on Wednesday. On Thursday, we get initial jobless claims plus PPI readings from the US and China. Then on Friday, a little bit later this week, markets will be closed for Good Friday. in the United States. So let's get some final thoughts, shall we, from Stuart Kaiser of UPS. Stuart, you and I have talked about this a couple of times over the last few weeks, working through a peak in volatility. Give me your update on that right now, Stuart.
Great. Good morning, John. Thanks very much. I think the update is pretty positive, actually. On a cross-asset basis, the pricing of risk has come down pretty significantly over the past couple of weeks. But I do think you're seeing the impact much more in areas that the Fed itself is directly impacting. So things like rates volatility, IG bond markets, things of that nature. Whereas, high yield and equity markets, which have a little more freedom to move and respond to the headlines and data, haven't come in quite a bit as much. I think the easiest way to highlight that would be if you just look at the ratio of the VIX to the TY VIX, so equity versus bond volatility. That ratio is at almost 8 times, which would be higher than we had during the financial crisis. So definitely significant progress, but in our view, not quite at all clear and still some things that need to be worked out by the market.
Yeah, people working through the same calculation as you, Stuart, trying to understand whether prospective peaks in the kind of places in the markets that you're looking at mean that we may or may not retest the bottom. How do you think about that situation at the moment, Stuart?
I mean, our view has been that we're much more confident saying that volatility has peaked than saying that the markets have found their bottom. I think a lot of the vol spike we saw early in this event had a lot to do with the markets just not functioning well, and the Fed has tried to step in to fix those. But now we're at the point where equities, and I would say high yield as well, are trying to digest, how bad a hit we're going to have to growth and how negative that might be to earnings. If you look at the uncertainty around equity EPS estimates, it's at about 10%, so 10% standard deviation in S&P EPS. That number got up to 15% during the financial crisis. So I think in our view, there are still a lot of negative revisions to earnings to come, and the uncertainty around those earnings is probably going to increase meaningfully as well. So, we're not going to necessarily call a top or a bottom, but, I do think there's a risk here that equity markets still need to digest a profit hit that, hasn't been fully priced yet.
I think a lot of people feel the same way. Stuart Kaiser there. Stuart, always great to get your thoughts on this programme. Looking forward to getting you back soon. My best to you and yours and the team over at UPS. That does it for me from New York. 3-4 more trading days still ahead of us. We'll wrap things up on Thursday. Please do reach out to me at Ferro TV on Twitter for more. From New York, this was the Countdown to the Open. This is Bloomberg TV.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food, they're able to buy things, they're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things in life happens, you know. I'm here by myself.
So ¿dónde vive acá? En la parte de...
This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue, and it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a Juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname
Pocahontas.
Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty.
The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and
Looking for the right online broker? E-Trade is the complete package for traders with intuitive tools and specialized support.
Shake Shack founded on this concept of people want to get together, hang out outside, and eat hamburgers and hot dogs.
Hello, sorry about that, guys. I am back, I believe.
Oh, Ming, there we go.
It's crazy. 7 years of college, you know, I should have paid attention.
No, hey, we're all getting used to working from home, that much is for sure. But Ming, we just heard Randy Garuti, CEO of Shake Shack, come out here and keep it real about the state of his business and the restaurant industry. So as a restaurateur and an owner of Blue Dragon in Massachusetts, what's the state of your business right now? Are you paying employees? What are you doing with the stimulus plan?
So, like for every business, every day is different. We closed Blue Dragon down the Friday before the state actually closed down everything in Boston. I closed it down because people were still gathering. We tried to take half the rest tables out for separation. This young crowd didn't pay attention. Actually, there was a toast for coronavirus with a group of millennials. And once I saw them toast coronavirus, I'm like, okay, we're cutting this off. We're closed. Proudly never closed Blue Dragon all the way. I had to let go 25 of my 28 people. I kept my 3 salary people to try to keep the lights on. Starting that Monday, we've started no contact to go. So for the deliveries people and for people that can pick up, completely no contact to protocol, mask, hair nets, gloves, the whole 9 yards. You pick it up outside. And honestly, we were doing about 10% of normal revenue. So
I think on
any
this one,
business you're in, 10%
if it
normal
drops
revenue,
down
you're
to
not
this line
gonna cut it.
again, I might take
Fortunately, so
profit.
we were just at the point 2 weeks
And I have
into
2
it. What are we
trades here,
going
and
to
if
do?
it
Then
keeps
the Lee
dropping,
Initiative. So Chef
I
Ed Lee,
take
my
it. If
buddy
it
from
shoots back
Kentucky,
up,
with
I'm
a
placing
very
another
smart
trade right here.
partnership with Maker's Mark, the bourbon company. Ed Lee approached him and said, look, you have all this promotional money for every major city for the next 4 months. Those gatherings, those promos, those parties aren't happening. Give us that money, that seed money, and we'll seed restaurants across the country in different states. So Ed called me to do Boston. So now we have proudly set up a food bank, started this last Monday. People, anyone in the restaurant industry with the pay stub can come and pick up dinner for 1 or dinner for 4 to cook themselves, plus a whole board of toiletries, including besides deodorant and the Purells and stuff, bags of rice, dried rice, bags of beans, tuna fish, Spam. Reason being, there's nothing more normal than to be able to cook at home. I mean, it's just been a nightmare. And we talk about the bailout that came from the government. That it's not bad, and we're good. And I've already applied for the SBA, all that stuff. That's great unless you are under the radar, unless you are one of the millions and millions of employees that work for any service industry, hotel, restaurant, landscaping, and actually will not get an unemployment check, will not get any bailout money. They're the ones that actually, under the radar, usually send money home. They have nowhere to go. They're the ones that are just going to suffer the most, which in most disasters, the poorest do suffer the most. But economically right now, it's so scary. I mean, I'm going to repeat what Randy said. Restaurants are a community. Restaurants are the glue of the community. And I love what Jose Andres wrote last time in the New York Times op-eds last Sunday about the government needs to seed all restaurants, pay for their food, their lodging, their people, and give food out free. These restaurants, mom and pops, need to be working. Once they're closed, they're closed. I mean, there's 15, 20% Chinatown restaurants that are permanently closed, never coming back. In New York, you have Alfa Portali's, Gotham Bar and Grill, and Toro. Great restaurants. Here in Boston, we just had a steakhouse. Fleming's just closed. These are mainstay restaurants that were actually doing pretty good, but they cannot sustain. So we need a bailout. Otherwise, you said 30% earlier, Brian. I think 50% of mom and pops can maybe not get through this. Because even with this bailout money and the SBA loan, it's assuming you're going to bring back full staff. And no one brings back full staff there's something like this. You're not going to have full staff. So you're not going to get that full reimbursement. It also doesn't include the inventory you need to buy in. You need to buy booze again and fish and veg and protein. So all of this is like, oh, yeah, they'll just reopen miraculously. That doesn't happen. Plus, as you know, it's one last point. As you know, when I do open my doors, let's say in May or June, there's not going to be a line of 200 people coming into my restaurant, right? Everyone was affected by this. So it's tough. It's really tough.
I mean, you've called this catastrophic for restaurant workers, and you point out that oftentimes many of them are living paycheck to paycheck. You started something called the Restaurant Strong Fund. It's an online fundraiser. Can you tell us what that is and how has it been going?
Sure. So I've really been doing 3 things. So the Lee Initiative is the one that's doing the food bank. Restaurant Strong, hats off to our buddies at Boston Beer Works, so Boston, Sam Adams. They reached out to Ken Orange and myself and Chris Coombs. We did an event called Boston Bites Back right after the marathon bombing. So Sam reached out and says, how can we help? They're so generous. And with seed money from Sam Adams, through the Greg Hill Foundation of 501c3, we started promoting We Have to Save the Industry, called Restaurant Strong. We collected for over $500,000, which is a great amount of money, and then started passing out $1,000 checks to anyone in the restaurant industry that had a pay stub. That's people, bluntly, legal or illegal. Didn't matter. If you needed the money, we paid it out. We paid out 510 checks, so $510,000. So it's an awesome thing, which we did. There's 16,000 restaurants in Massachusetts alone. So it is a drop in the bucket, and it does provide hope. But that's, like I said, 500 people out of 16,000 restaurants got help there. So we need what we did to Restaurant Strong, literally times 1,000. They smartly, now Sam Adams has contributed $2 million to the cause, and they're going over to about 15 different cities in the country. Greatly needed, but we need about 50 Sam Adams to step up, like the Maker's Mark, like a lot of big companies, like Apple stands up. Everyone needs to stand up to realize that we cannot not eat, right? If the car companies close down a little bit, the cruise lines and the airlines and the big banks, that's still okay, because I don't need to buy a car today. However, I do need to eat today, as does everyone else. And I have been eating, and there's so many people that are right now with they have this much money. Do I pay rent, or do I eat or pay for food? And at a certain point, it's gonna break, and that's what we're scared of.
Ming, real quickly, I just want to confirm to any of your employees that are watching, you expect to be open by June, the latest?
That's what we're hoping. Yeah, I mean, again, they say New York in 2 weeks super peaking, and Boston 3 weeks is going to peak. What does this fallout look like after the peak? I mean, literally, how many people are going to be sick? One of my issues is just, I didn't expect this because I'm new at this, is we had the budget with the lead initiative to bring back 5 or 6 cooks. One cook, too scared to ride public transportation and jumping in an Uber. I completely get it. One has an elderly father at home. He can't risk to be exposed. One daughter has a fever. He's not going to risk exposure to us. So all these nuances that have never happened after a 9/11 or a Katrina, there we just went in and cooked. Here, it's just about safety first. And, we're wearing everything possibly safe, but it's, at the end of the day, we will get through this. And if I could just add my one bit to every restaurant person thinking about this. I mean, I've cried all my cries, all my tears. So I've done that. It's so hard for us right now. You really need to just take care of the person to your right and to your left. I've been saying this. Right now, the divisiveness of the world, this country has been going on for so long. That's got to stop. There's only 3 types of people in this world now. It's not skin color. It's not political views, not race. There's healthy, there's people that are caring, and there's people that are dying. That's it, guys. There's 3 people in the world. Either you're healthy, you got the virus, or you're dying. So knowing that's a level playing field. You have to take care of your guy on your right and your left, because that may be all you have left. But we have to take care of each other. We have to be kind. And I just pray that little guiding light that's going to come out of this is we do realize we're all the same, and we have to take care of each other. And food is the best way to start this process.
All right, well said. Let's leave it there. Ming Tsai, chef and owner of Blue Dragon. I appreciate your thoughts, and we're certainly rooting for you.
Thank you so much. Take care.
And do stick around. We'll have much more on the markets straight ahead.
No, they were good though. They were good. They were good interviews.
Welcome back to Yahoo Finance Live. I want to bring in our tech editor, Dan Halley. Dan, good to see you. And amidst all this, Quibi is launching today. What is Quibi?
Yeah, Quibi launching at probably the worst time for them. Specifically, it's a video platform that's built specifically for smartphones, so it's only on smartphones, and it's meant to provide these kind of bite size. That's where the name comes from, quick bites of entertainment. Anything. I mean, you're not going to get anything that lasts anything near what you would expect a normal video show, TV show, movie, anything along those lines to last. We're talking seconds here. And really what it's going to do is bring together celebrities from across the spectrum and put them into this platform for your smartphone. There's a free version that has there's a free trial. And then there's an advertised version that comes for $5 a month and an advertising-free version that's $8 a month. It really seems to be this very controversial kind of platform, though, because people are taking very separate stances on it. Either they feel like it's going to fail out of the gate or they feel like it's going to last. We will see. But again, this was something that was originally launched as kind of a distraction for people when they're on the subway or when they're in the line for their coffee. And this is really not the time for that.
No, Dan, if I had to choose between Quibi and Netflix, I'm going with Netflix. Just got to say. All right, Dan Halley, thank you. And a quick recap of the market. You're seeing markets in full-on rally mode. The Dow up close to 1,000 points. I do want to quickly highlight some action in the markets. Zoom Video Communications down about 7% here. So a downgrade by the sell side this morning, too. Also had the founder in a Wall Street Journal article over the weekend said they messed up on the security front, much more focused on how the platform is used. But make no mistake about it, right now, Zoom has become the new Google. It's one word, and you all get it. But do stick around. We'll have much more on Yahoo Finance Live on the markets straight ahead.
Welcome to Yahoo Finance on this Monday, April 6th. We are broadcasting from all of our homes and apartments here in the New York metro area, letting you know that the S&P 500 right now is up more than 100 points. The Dow is up more than 968 points. The NASDAQ is up more than 330 points. We've got an eye on this rally, and we're going to keep you informed. But now the headlines which are making these markets move. First, the Surgeon General, Jerome Adams, he said over the weekend, this is the pivotal week and, quote, will be our Pearl Harbor moment. Cases of coronavirus worldwide now 1.2+ million, almost 1.3 million. dead, 70,624. Here in the United States, we're approaching 338,000 cases, with almost 10,000 people who we have lost. Marco Rubio, the senator from Florida, has said that there will need to be more money to fund the PPP, the Paycheck Protection Program, launched last week. He says Congress will have to replenish that money. Remember, $349 billion. We're going to talk about some of the snafus that are keeping small businesses from getting that much needed money. Also, Jamie Dimon has said that JP Morgan Chase may have to suspend its dividend to preserve capital. The country, he says, is headed toward a bad recession. And Janet Yellen, former chair of the Federal Reserve, has said GDP could decline 30% this quarter. Unemployment, she says, is already almost 13%. We've got the entire Yahoo Finance team on standby. We want to go straight to Anjali Kamlani, who's got the latest for us on the coronavirus. Anjali?
Thanks, Adam. Yep, as you mentioned just a moments ago, we do know that that global count is more than 1.2, nearing 1.3 million. Unfortunately, with the U.S. at more than 330,000, and nearly half of those are, in fact, in New York State. And as we know, that is the hardest hit, and this is supposed to be possibly the hardest week for them, in addition to watching the rest of the country and certain metro areas surge. We do know that the West Coast, which first started off as the center of the outbreak, has seen some promising news in the last couple of weeks. We've been watching them sort of decrease. And we know that Washington State just recently returned ventilators to the national stockpile. So that is as well promising news. We do know that in the vaccine segment, two candidates. So we know that Moderna was already out there. And of the vaccine candidates, we also know that Inovio is now approved for vaccine trials. And those two were Bill Gates-backed companies, as well as getting funding from CEPI, that European nonprofit. In addition, we know that CVS has just started doing their drive-through testing in Georgia and Rhode Island, and that one is finally open to the public. We know earlier they had opened one in Massachusetts, which they used as sort of a testing ground and had been only available to healthcare workers. So good news starting out there. It is by appointment only, but that's a new step away from the FEMA-run drive-throughs. Adam?
Anjali, thank you. Want to get to the urgent business of helping small businesses get through this crisis. $349 billion was begun to be made available on Friday. But Citibank, one of the largest banks in the United States, sent an email to its clients saying, and this was the closing of that email, quote, "While we are working as quickly as we can, Citi is not yet able to accept the PPP loan applications." A lot of small business owners are being hurt by Citi's inability to process these claims. Brian Chung is following the latest on what's happening on this front for us. Brian?
Well, Adam, the update from Citi, as I just checked their website, they're still not open yet. That means that of the four largest banks in the United States, Citi is the last one to be able to launch this program, which, as you recall, was supposed to be opened on Friday. But as we know, only two of the four major banks were actually able to open portals on Friday. That was Bank of America and also Chase, or JP Morgan. Bank of America was the first to go in the morning on Friday, had enormous issues with a number of Bank of America checking clients saying they could not actually successfully submit an application because they did not have an outstanding loan with Bank of America. Even those that had loans but paid them off in the past were also denied the ability to process an application. Bank of America did later on clarify that they are taking applications from any sort of clients that do have a loan or lending relationship with the bank. It just would be in a second batch, or I guess they would reopen the applications at a later point. I did hear some anecdotes of business owners that did not have an outstanding loan but did have a checking account that were ultimately able to get through the portal. Now, Bank of America says as of Saturday, it received 145,000 applications for a total of $30 billion of loans. They still need to be vetted to make sure that they can underwrite those loans, but that's the amount that's been applied for. Wells Fargo did actually launch their portal on Saturday. They said that, though, they'll have to cap the loan issuance to $10 billion because, as we know, Wells Fargo is facing an asset cap from the Federal Reserve as a result of their fake account scandal from a few years ago. But regardless, it seems like it was a rough way to get started for all of these banks. For what it's worth, Stephen Mnuchin, the head of the U.S. Treasury, said as of an update on Friday that $1.8 billion of loans had been processed. Keep in mind, Adam, this is a $350 billion program.
And Brian, it's Julie here. The question is, will $350 billion even be enough? Even though we have some banks who aren't ready yet or who are having issues processing all of that volume, with that inundation, you would imagine that they'd get to 350 fairly quickly. I mean, you know the numbers on how many applications they've gotten. Do we know how much, the amount of money that they're lending out yet as a part of all this?
We don't have an exact total yet, and a lot of that could be because of the fact that even though a lot of these banks have received applications, they still need to decide ultimately who's going to get those loans. But you imagine with the pipeline of money that's coming from that $350 billion of appropriations, hopefully most of the people that apply will ultimately be able to successfully get the loan. But you raise an interesting point, which is how do we know that $350 billion is enough? As of Friday, $1.8 billion is a drop in the bucket from the total amount that was appropriated. But President Trump did say on Saturday, he launched a tweet saying that ultimately, if the federal government needs to provide more money to this PPP program, they can do that. But again, the issue for right now doesn't seem to be necessarily the size of the pot, but the actual means by which they're distributing that money, which, as a lot of lawmakers like Marco Rubio from Florida have pointed out, seems to be much more of a logistical issue than I think a lot of policymakers had originally hoped for when they originally drafted the bill.
As we watch these banks in action or inaction, Brian, I'm curious, wasn't today the stress test, the results we were going to get the stress? I can't imagine the banks being under any more real world stress than they are now.
Well, the stress tests are still going on as scheduled. And for those that are unaware, this is a process that the Federal Reserve has done for years after the last financial crisis, where they apply a number of stress scenarios to a bank to see if their balance sheet could survive any sort of theoretical shock. In practice, it seems like that's happening in the real world right now. But for what it's worth, the Federal Reserve and the other bank regulators have provided a little bit of wiggle room for some of these banks on a regulatory basis. There's some concern that with some of the regulations, banks might be told to keep too much capital trapped on their balance sheet for regulatory purposes, when in theory they might need to use that capital to lend out to those Main Street businesses that really need the help right now. So the Federal Reserve has loosened a few of those regulations, but the stress tests are still going on as scheduled, and the results we won't have today, but the Federal Reserve is still undergoing that process.
All right, we appreciate your input, and remember that Brian Chung is our Fed head here at Yahoo Finance. So when he speaks about the Fed, you want to listen. Brian, thank you very much. Want to talk about the men and women who are on the front lines of this crisis, not at the
What's up, everybody?
but at the grocery stores
I'm
nationwide.
back.
These men and women
I'm in.
keeping us fed,
My mic was
and
muted,
to help talk about the
but I'm
steps
back.
being done to protect them and safeguard them. Mark Perrone is joining us. He is the United Food and Commercial Workers President, the union that represents them. Sir, it is good to have you here. And, you know, just within the last week or two, your union has made great strides in pay increases.
Still hanging in there on some of these
women
trades right now.
funded as they keep us fed. Can you bring us up to speed on what still needs to be done?
Well, I think that what really needs to be done is that they need masks. And I think that we need to talk about the customers that go in the
This one looks
stores
real
as
good.
well. We have one set of stores like in New Jersey.
I got in this trade.
That about 25%
Actually,
of
this
the
is a what,
stores
30
have
minute
already
candle?
been
Let me pull up the
identified
5
as
chart.
having somebody that was positive
Actually, I'm gonna go to the 1
COVID-19
hour
that
chart.
work
Let's
there
go to the
now.
1.
And if they don't receive some of this, you know, protective
All right, so I got in this trade.
equipment that they
What time is it? It's
need,
11
I think we're going to see
a.m.
more
Eastern Standard.
transmission take place in
I
these
got in this
stores.
trade
If you think about the hospitals where you have
midnight
a lot
of,
of people that are,
well, really, this morning,
you know,
12
infected
o'clock.
by the virus, and then you look at other
midnight.
large locations, like an average grocery store in New
So that's a
Jersey
good
would
downtrend.
do
So,
about 1,200 people per
of
day.
course, you know, as usual,
One day last week,
soon
one
to
of
get in the
those
trade
stores
as
did
usual.
10,000 people.
You go
in
through
a
the
day.
drawdown. That's how it
So when
always
you
goes.
think about the number of
And then I
people
was on a
going
good
through
trend.
those stores and the
And
potential
I think
people
right
that
here
can
it did a
be
pullback because of the
asymptomatic,
news.
you have to
This was a little
ultimately
news pullback,
consider
but it's
what
okay though,
can you do to
because when
stop
you
that
see green like
transmission.
that and then it comes back down,
You
that means
can
a healthy
limit the number
downtrend.
of people inside
Because
the
if it just
store,
drops straight down
as well
in
as
one
put masks
direction,
on everybody that are
then
coming in
it's
and
going to be
out. And I
well,
think that would
usually there's
be
like a real big correction.
the first thing I would like to see that would ultimately,
Yeah, I think a lot of people would agree with you.
So this looks like a healthy downtrend.
So, but we have, in fact, I think that
why did I pay
most
right
of
here?
our
I don't remember why I
employers
paid right here. Let me
understood the
check.
impact and the necessity in order
I
to
don't know why I have
pay
my take.
people
I have my
essential
take
worker
profit
pay.
sitting right here.
The reason why I
The
think
first
they
time
did it is because they were concerned
because
that they wanted
of
to have
I think this line,
employees who knew their
but I didn't even
operation
take profit.
that ultimately didn't become so
what I
afraid they
did was
left work.
Right.
and they
I
were
took
willing
off
to
to
pay,
take
and I
profit
think they were willing to pay
because I think it's going to keep dropping.
Mark,
So I
this is
took the take
Julie here.
profit
I just
off.
want to get back to that
I'm
mask
gonna let it
issue
keep
for a moment
going.
because I think this is something that hits
I'm
home
gonna let it keep
for a
running
lot
until it
of
looks like it's
customers
not
who are
gonna
coming into
keep
those
dropping.
stores.
So
And,
make all the money I can make
as you
off this one
mentioned, these
trade.
are effectively frontline workers right now, the
Euro
people who are
GBP, I
bringing
got
us
this
our
one
food and essential
a couple
items.
hours ago. Of
I went
course, I'm in the
into a
drawdown
grocery store
phase.
over the weekend
In the
where you
red,
had
it's
a
all
partition
good.
at the cash register,
I'm trading this one off the
but
4-hour
the
candle,
workers,
so I'm
as
gonna
you say,
suffer a
were
little
not wearing
drawdown for right
masks.
now.
The stock people
It's
certainly
all
weren't
good though,
wearing
because
masks who were stocking
it's
the
on the
shelves.
downtrend.
What are you
And then, of course,
hearing from these grocery
well,
store
this is the
chains
weekend, first of
about
all.
why they
So
would
that's why I
not
think this looks like
implement
this because of the
mandatory
weekend.
masks
And
and
on the weekend,
mandatory
there's a gap in the
gloves
market.
for everyone working in the store?
I
And,
think initially,
I mean, if I got
Julie,
a
it
better
was
entry, it would have
this,
been better,
right?
but
The
it's okay though.
CDC came
I
out with
caught
a
it when it was
report that
coming
said,
up,
don't
so
wear the
I'm just waiting on
mask
it to come
unless
back
you're
down.
sick. And
And
I
once it
think
comes
that a
back
lot of the
down,
grocery
see,
companies
the 4
thought,
hour looks
oh
real
my
good. The
God,
4 hour looks real
if
bearish.
my people are wearing
And then
masks,
the reason what
everybody's going to
made
think
me
they're sick
truly got
when
into
they
this
really
trade
weren't.
wasn't the 4 hour
Unfortunately,
candle,
the
but one, it was a
CDC
good
didn't come out
entry
with
in
the
the 4 hour
guidelines that they
candle,
came out with this last
and
weekend until
the
recently.
daily
Had
looks
that
real
been the
good.
case, had they done that in the initial stages,
So
I think that
let's see what
people would have
happens.
been much more apt to wear the
Let's
mask.
see what happens
Even now, today, there's still some hesitation by
with
some
that
of our
ride out for a
employers
bit.
to tell people to put masks on. Now, as of
Now, if I
last
can get
week,
this to keep coming down for a little bit, the
all of
daily
my
look even
major
better.
employers have agreed
But I'm gonna
that
wait
if, in
patiently for
fact,
that.
employees have their own personal masks, that they
This
don't
one I
have
just
any
got
issues
in.
about them wearing them.
I don't
But
know
I
what's gonna
still
happen
think
here.
there's some concerns about it at the ground level. A decision can
I
be
might need
made at the
to fix my
top.
stop loss a little bit on this
However,
one.
by the time it gets down to the store level, there's still people that have different views about what it
I
should be
see.
like. I mean,
Mark?
honestly, our president said this weekend, he said he's not going to wear a mask. And I think that sends some mixed messages from time to time.
Mark, I asked this question as a former bag boy many thousands of years ago at public supermarkets in South Florida. I remember when we were switching from
This one might
paper
hit my
bags
stop. I don't
to
know.
plastic bags. Now in New York City, they've made plastic illegal, but it was right at the same time COVID-19 was becoming a crisis. So the stores are still in a flux. Do you know, is there any information as to what would be safer, not only for customers, but for your members, whether it's bagging in plastic or in paper?
Well, I can tell you two things. Paper would be better, right? Because it doesn't last as long on paper as it does on plastic. What we're concerned with right now is reusable and people bringing their own bags back in from their homes because we don't know where those bags have been. We don't know whether or not they were disinfected.
This
so
one, of course,
if I had
still
my
stuck in
choice, it'd be
consolidation
paper
zone.
first, plastic next,
Oh,
and
man.
reusable, not at all.
So that's the
You bring
third
up a
tap.
good point with reusable.
Hopefully
I
it
was
keeps
thinking
coming
about
down.
that going to the grocery store
I
here in
think
New
when
York
it comes
City.
here,
And
I'm
by
gonna
the
do a
way, they
take
now
profit.
limit
I got two
how many
trades here.
people at a lot of
So
the
I think I'm
stores
gonna
can
do a
go in
take
at any
profit
one
right
time.
here
But
on
we
one of the
appreciate
trades,
your being here,
just
and
so I
we
can
know
get out
that
the
the men and
draw,
women at the
so I
grocery
can
stores across the
be in the
country
drawdown so
are a
long.
crucial part of getting us through the crisis. Mark
And
Barone,
then if it keeps
president
coming
of
down,
the
then that other
UFCW
trade will be real
International. Good
good.
to
But
have
if
you
it
here.
shoots
We
back
look
up
forward to
again,
having you come back
then I'll
on
do another
when
trade
this
here.
crisis
So that way when I
starts
go
to
back
ebb.
to break even
Adam,
here with the
thank you.
first, the other
You've
trade,
got it. I'm going to take a look at
I'll be
markets
fine.
right now as I figure out what we're going to do next, and want to let you know that we're enjoying a rally on Wall Street. The Dow is
This
up,
one,
as you know, 1,000
moving
points. The S&P
sideways,
500 up
consolidation state, of
115
course.
points, and the Nasdaq is up 351 points. So, what have people been buying and selling in the markets? Want to bring in JJ Kinahan. He's TD Ameritrade's chief market strategist, and of course, they have an index, a measure to let us know where things are going. And it's good to have you here, JJ. I am curious because I know millennials, one of the things you've pointed out is that millennials actually were buying, and this surprised me, Royal Caribbean. Any information as to why? JJ, you have to hit *6 to unmute your phone.
Adam, I apologize for the technical difficulties I had this morning.
No problem.
First of all, and thank you for having me. The work from home environment has us all in a new space. But back to your point, Adam, as to why they are buying that stock. I think a lot of it has to do with price. You know, a lot of other stocks are pretty expensive in terms of just pure dollars is what I'm talking about. This one seems to be one that's fairly inexpensive. You know, we talk all the time about having a time horizon. If you're a young person, I would think your thought being, okay, they may have a little bit of a tougher time in the short term, but in the longer term, at some point, the hope is obviously people want to go on cruises again. I don't think any of us are rushing out to do it tomorrow, but, you know, longer term, I think they believe they'll come back. And also, I think on things like this, when they do come back, you know, whereas you and I who've been around a little longer may not be the first ones to jump on board. If you're a younger person, you're like, well, this is a pretty cheap cruise. Things seem to be going well. I'm healthy. Why wouldn't I be somebody who goes back? So they may be the first users of the products when, you know, the sort of all clear is given.
Hey, JJ, it's Julie here. Speaking of cruise lines, we learned today that Saudi Arabia's sovereign wealth fund had bought 43.5 million shares in Carnival. So they own now more than 8% of that stock. So obviously others are also trying to find value out in the market here. That seemed to be sort of a theme. It wasn't just cruise lines, right? Things like ExxonMobil were also being bought by people using TD Ameritrade. So it seemed like that was sort of a theme. People were looking at these sort of crushed stocks.
Absolutely, Julie. And, you know, as you look at the general population away from just the millennials,
Carnival.
you know, the millennials, obviously the cruise lines and Uber were two of the stocks, whereas few
What's
of the
up,
stocks
bro?
that they
That
found
thing
very
dropping
interesting,
tomorrow.
but our more
That
general
thing dropping low. What do you
population,
think? What's
the
dropping
one
low,
thing I
bro?
would say
I
that
don't know what you're talking
they
about.
shared in common in the stocks they bought last month were stocks that had weathered crises before, be it 2008, 9/11, whatever it may be, you know, Exxon, Boeing, Ford, Disney, and sat on a lot of cash. You know, and so I think that also is something that they had in common and have all been, you know, Ford obviously a low price stock, so I'll take that out of the conversation for a moment. But when I look at Boeing, Exxon, and Disney, these are also stocks that have just gotten significantly beaten up over time, over the last few weeks. The other interesting pattern we saw in this,
Which one you
guys,
think
which
is
I
going to
think you'll
drop?
find particularly interesting, is the first 2 weeks of March, our clients were actually selling things. It was like right in the middle of the month, a gun went off or something that said, all right, time to start buying, because the behavior changed really, really quickly, sort of after that initial panic hit. To your point, Julie, people were like, hold on, these stocks have gotten beaten up. Long term, I still believe in these companies and what they're doing, and I think that they'll be good as time goes on.
Hey, JJ, it's Brian Chung here. Obviously, we know that we've seen outflows in equities, but I'm wondering how much inflow have you seen into ETFs as people try to avoid value investing and just want to try to buy the market if they think that we've reached the bottom, which, you know, jury's still out on that one. But are you seeing any sort of interest into where equity ETFs are kind of going here?
Yeah, well, we tend to generally have big interest, particularly in the ones that are based on stock indexes, you know, the spiders, QQQs, IWM. And so a lot of the buying was based on S&P 500 type companies in March. You know, the corresponding ETFs also went hand in hand with them. So I do think
I
that
think
there
you know
is
what?
sort of
I think
this
I'm gonna set my
little
take
bit of a
profit on
split
this
between
trade
people who were like, okay,
to this.
companies that I like have just gotten so
That's a good. That seems
destroyed
to be a good
that I'm
spot.
going to go toward that individual company because I believe that it's going to come back. But there was a lot of people that are also like, I'm just a big believer in
That
what's
seems to be a good
happened,
spot for a take
that
profit.
the market itself is going to recover
But if
significantly. I
it
don't
looks like it
necessarily
still
want to
wants to
pick the
drop more than
individual winners and
this,
losers. The interesting
then my
thing is
next
you
level
did
will
have a
be
little
about
bit
right
more,
here.
perhaps, of the general ETF buying than maybe sectors, as those who bought it just
But for
believed that the
now, I'm
full
gonna have my
market would
take
come
profit
back.
set to this.
JJ, Julie, again, I also just saw some data from JP Morgan that retail investors are starting to get back into some of the equity mutual funds. That combined with the data you're seeing,
Damn,
have you seen a
man, I
bottom in
was
stocks?
hoping this dropped down some more.
You know, I don't know that we've seen a bottom, but we have seen, Julie, which I like
It's all
to see
good.
because
It's all
this is
good.
what definitely forms
Can't
a
get
bottom,
greedy.
is that the ranges are getting smaller overall. Now, today may be a little bit outside that to the upside, but we'll see where we end up. But, we're not hitting those 5% up, 5% down
Oh,
overnight.
there goes my
Now
stop
we're getting
loss.
to where the range is, and I know it sounds crazy and almost
Stupid
laughable to say,
trade,
yeah, the range
man.
is falling. We're only getting 100 S&P point moves overnight and the next day now. I
This
think
is the
we want to
baby
get
right
to a
here.
point where we're at 50
This
points.
one right here, this is the trade that's going to
throughout
pay
the
the
day,
rent.
because then you're returning more to normal. I think right now it's very difficult.
This thing
when
act right and just
you
keep
have so
coming
many great
down.
guests
This one's
on
the one
here,
that's going to pay
for
the
somebody
rent.
to come on and say, here's definitely where I see support, here's definitely where I see resistance, that's a really difficult thing to say when we're bouncing around this much. So I think when we can get back to the point where people have some true conviction behind those intraday numbers, will actually help and will help the volatility come through. That said, I don't see that happening for a little while. We just as you guys were nice enough to have me last year, we talked a lot about the tariffs and how they were always the underlying story. You may have some news during the day, but if there was tariff news that overtook everything, well, this is that on steroids. And the fact that you may have some other news about companies, but especially as we get into earnings when you guys are reporting on it next week. But the coronavirus story, if there's something there, it's going to just blow everything else away. Yes.
I'm curious, is the index, the investor movement index, old enough for you to work in the kind of demand destruction we're witnessing? I realize that we haven't had this kind of demand destruction in our lifetimes, but is that a kind of model that could weigh how you balance that? Because that would give you an indication whether this question of a bottom is legitimate with what you're seeing in movement of stock purchases, wouldn't it?
Yeah, it would, Adam, and I would say this, given the fact what I just said about those last 2 weeks of the month, let's put it this way. There was a strong belief, I think, in our client activity that, that we saw what could be, people saying, hey, I think this could be a bottom, or certainly this is a level I'm very comfortable putting a lot of my money to work at. That's not to say that we can't have one more leg down, but I do think at least we've reached a level where you're starting to see significant amounts of money hitting the market.
All right. JJ Kinahan is TD Ameritrade's chief market strategist. Good to have you here on Yahoo Finance. Right now,
Thanks for having
stocks
me, guys.
are rallying, and we can see that the S&P 500 is up more than 100 points. Dow's up almost 1,000 points, and NASDAQ up more than 300 points. We have more for you on Yahoo Finance right after this.
As an active intraday trader, you know one good day is not enough. You need consistent profit. So how confident are you that your current strategy will work again and again? We're SMB Capital, one of the most consistently successful proprietary trading desks on Wall Street, located in the heart of New York City. Our New York trading desk has over 40 professional day traders, the best of whom are now big seven-figure earners.
And welcome back to Yahoo Finance as we watch a rally on Wall Street right now. Off of the session highs, but not by much. The Dow is still up over 970 points. Want to talk about how the coronavirus, COVID-19, is changing the world all of us exist in. And one of the big questions surrounding this is what's going to happen with global development. Raj Kumar is president and editor-in-chief of DevEx. To give you an idea of their scope, they serve a community of 1 million global development professionals worldwide. He joins us now. And I guess one of the issues that the people in your community are dealing with, but some of us are experiencing, is this concept of contactless delivery. What are the ramifications of that going forward?
Yeah, thanks, Adam. Nice to be with you. I mean, this is an industry of people who are on the front lines of some of the poorest countries in the world dealing with humanitarian crises, and they're scrambling just like everybody else, right? Just like every other industry, trying to figure out how do we change the way we work. And so, one of the things that we've highlighted recently at DevEx is this Turkish-based organization that has set up a digital map where if you need support or aid, let's say to support a Syrian refugee, you can say, this is what's required in our local school. These are the materials and supplies, and then a donor, an individual or an organization can
What's up,
go
bro?
online and
What's
donate
up, man?
those things, send them through a third-party service and get them delivered. And it's kind of an idea of getting to contactless aid delivery. The basic idea is, can we find a way to stop sending aid workers and not-for-profit professionals all over the world?
Doing all right,
Travel
bro?
is a big part of how this field works. Is there a way to kind of get around that in these extreme circumstances that we're facing? And this is just one example, but I think it points to how dramatically people are struggling to figure out how does a field work?
Doing all right, bro?
When you can't
Just
travel,
working, bro.
and you need to be in a lot of the lowest
Hey,
income parts
man,
of
I
the
know
world.
how it
You
is,
need to go to
bro.
refugee camps. You need to work in places in
Gotta
slums and
keep
urban
that
slums
hustle
where people are
going, bro.
packed in. How do
Let
we
me look
change
at
the
this
way we
market one more
actually
time.
work to respond to the realities we're in today? So big questions that our community is asking. This is among them.
Raj, it's Julie Hyman here. Thanks for joining us. As you talk about the challenge facing these various NGOs, they're enormous. What are they telling you right now about how optimistic or pessimistic they are? I mean, certainly the sort of talk has been that we are going to see this pandemic really rip through the poorest, most densely populated areas, as you were just discussing. Do they feel like that they can do enough or anything to stem that?
Yeah, there's a lot of concern. I mean, these are people who are doers, and they're out in the front lines working every day on these issues. And they're used to big challenges, of course, but there's a lot of concern because in many of the countries we're talking about, the vast majority of workers are in the informal sector. I was in a slum in Nairobi just a few months ago, and average people there, they have to get out of their house. They've got to go and sell fruits and vegetables in the street. There isn't an employer who's sending them a paycheck every week or two. So it's really hard to do social distancing in these environments. People have to leave the house. They have to work. And so, what we see is the likely scenario that you're going to have this pandemic spread more quickly through some of the poorer countries in the world where there is that dense population, the inability to isolate. And yeah, it's true. Some of these populations are a lot younger. It's not like Northern Italy. That's one of the potential advantages, but there's also a lot of underlying health conditions in many of the poorest places in the world. So there is a lot of concern. And the nonprofits, the NGOs, the international agencies, this is what they're here for. This is why they exist, right? To try to do this kind of work. But in many cases, they lack even the basic personal protective equipment. There was a big uproar in India recently because almost 1 million community health workers, their job is to members of the community. Their job
Yo,
is to
Ron's
go
my
door to
boy. He's
door
a
and
trader
provide
too,
health
man.
services. They weren't even given
Hey, he might
very
not go.
basic
He
cloth
might not play
masks or
Dota,
any kind of protective gear. So,
but
there's a
he trades.
real concern,
So
and it's growing.
we
Most of the
cool.
focus, understandably, right now is what's
We
happening in New
cool.
York, what's happening in Spain, what's happening in a lot of the Western world where you see a tremendous peak of the virus. We're not yet focused on many of the poorest countries in the world, in part because the testing isn't that good yet. We don't know the real numbers. But the people I talk to in our field, they feel like this is going to go through phases, and the next big phase is going to see large countries in the developing world with very large caseloads of this virus and big consequences, big social disruption, big economic disruption in a lot of these parts of the world.
Raj, it's Julia LaRoche, and we certainly hear the growing concern there. What can be done? You were mentioning the PPE, for example, but what can be done from even like the business community? What can they do to help mitigate?
I just bought
some
some
of
more
this? Is there
Carnival
anything
stock
that
at
can help move
$10.
the needle for you guys?
I was waiting for it to drop at
businesses are stepping up, I think, in a lot of the world, but
to
these are
3,
some of the
but
most challenging
I'm gonna
environments to step
catch
up
a little
in.
wave going
And
up.
a
I'm
lot
gonna
of this
probably
is going to
sell
come
it.
down in the
We'll
long
see.
run to things like supply chains. A lot
10
of the
still
biggest
ain't bad,
corporations
so
here in the
10
U.S.
still not
when
bad
we
at
go to
all.
Starbucks and we buy coffee, where's it coming from? It's coming from a lot of the poorest countries in the world. So making sure those supply chains can stay strong, that the farmers at the end of that supply chain are able to keep their families safe and secure and have the resources to survive a pandemic like this. I think big corporates have a huge stake in ensuring that these systems stay up and running. And I think they're trying to figure it out just like the rest of us. Commitment is there, but what we're not yet seeing is a lot of flow of funding. So when I talk to the nonprofits, they're concerned that the big private foundations, they see their endowments shrinking as the stock markets decline. They might be hesitant to spend and increase their spending, or maybe they'll put more money into COVID-19 response, but the annual giving might slow down, or the individual giving to a lot of nonprofits might slow down. The galas, the charity balls, as average donors see their 401k.
What you say?
So
Bro,
I think there's a lot of financial pressure in this field. It's not the hospitality industry. It's not restaurants. It's not hotels. It's not in the front line in that sense. But it's a secondary one that is going to feel the pinch.
It's been like this for a
right.
while. I forgot you look
we
at the
appreciate your
15
being
minute.
here. The
It's been like this.
president and
Remember
editor-in-chief
the
at
consolidation
Devitt,
zone
and
I
we
was telling you
wish
about?
1 million people in the community you serve. We wish
Been doing
everybody
this for
the
a
best.
minute.
When we come
I'm just
back
hanging
on
in
Yahoo
there
Finance, I want to let
until
you
it
know
breaks a
that
direction.
we have the Chief Technology Officer as well as Executive Vice President of Microsoft. Kevin Scott is going to join us here on Yahoo Finance. That's next.
Yeah. You was going when I was trying to show you this. So look at this right here. I think I might have showed you this. Hold on. I go to the hourly chart. Maybe the 30-minute chart looks a little better. So it's still going down, but remember now, I tap right here. So just imagine price range. Just imagine. That's 220 pips, bro. Oh, you want me to see the beautiful alligator? Give me a second. I see this one. I'm in the alligator for a little minute on this one too. So this one right here, I don't know what this one gonna do. This one I might hold on. Let me look at this one again. This one might look like it's trying to pull back. That's a good sign. This one, yeah, I was just showing you that one. GJ, beautiful alligator. Let's see what time frame you're looking at. No, the alligator don't even look good on this one. The line's too close together.
The gain on the Dow
Like you want to
is
spread
back
out
above
and then
1,000
like this,
points in this
I
trading
spread
session
and
as
then
we
come
head
down.
towards 12
That's
noon
how you
here
want
at
it.
Yahoo Finance. Want to talk
If that's
to
what
you
you're
about
talking about,
steps
that's
that
a good one.
major technology companies are taking
If you're
to
talking
help
about
us
that, how it
deal
come
with
all the way out and then
COVID-19
come
and the
in,
coronavirus
that's the good
pandemic.
ones you like.
Joining us to talk
You don't want
about
the
that
ones
is
that's
Kevin
close together
Scott. He's
like that.
Microsoft's Chief Technology Officer and an Executive Vice President. He's also, by the way, author of the book Reprogramming the American Dream. Want to talk
Like I
to you
didn't trade this
first,
off the
though,
alligator.
about
I
the
traded
global
this one off
nightmare we're
support
all living through, and
resistance.
that's COVID-19. And this bot, I guess it's a kind of AI COVID-19 assessment bot that Microsoft has been working on. Where does that stand in conjunction with the CDC?
Yeah, so we developed a AI-powered bot to help people self-diagnose whether or not they should go seek medical attention if they have symptoms that may indicate that they have COVID-19. That bot is deployed on the CDC's website and is reachable by a couple of search engines.
Hi, sorry about that. This is Julie Hyman here. Nice to see you. Thanks for joining us. I want to ask you about Microsoft Teams as well, because obviously we have all seen a big uptick in demand for remote meetings right now. One of your competitors, Zoom, has faced some challenges in terms of privacy. For example, my kids who are in New York City schools, the DOE just announced they're not going to let them use Zoom anymore. What are you guys doing on the security front when it comes to Teams? And are you trying to maybe lure away some of those Zoom customers?
Well, we with all of our productivity and collaboration software, security and confidentiality has been one of our core engineering investments for several years now. We realize how important it is for customers, and we also realize that issues like data sovereignty, like where data resides and like where network traffic flows, are very important things as well. So we have a solid foundation there, and we also are taking extra measures to ensure that we can provide a strong foundation of security for everyone who's using these products. And like the need for them now is greater than it ever has been before. It's really been a great thing for us to be able to have these tools just for ourselves in order to be able to run our business during the shelter-in-place orders that are in effect in most places where we're operating.
Hey, Kevin, this is Dan Howley. Talking about AI, I know Microsoft has been doing a lot of work in health care prior to the coronavirus outbreak. Can you just kind of elaborate on that and where that's going now? If you're seeing any kind of turns toward maybe focusing more on global pandemics than where you were focusing before?
Yeah, there are a bunch of things that we're doing. Like one of the partnerships that we had in place before the pandemic is with a company called Adaptive Biotechnologies, and what we've been doing with them is trying to build a immune system profiling set of tools that uses the best of biotechnology, so PCR-based analysis that builds a profile of the T cells that are active in people's immune systems, and then using machine learning to try to figure out what diseases that immune system profile maps to, so that we can do better diagnostics, better recommendations for therapies for folks. And like we were very quickly able to pivot our efforts there, where hopefully we will very soon have in collaboration with Adaptive a set of diagnostic tools that will tell whether or not you've been exposed to the COVID-19 virus.
Kevin, I'm curious, and I'm stepping back to a much broader picture because you are the Chief Technology Officer at Microsoft. How is the internet in the United States, even globally, handling what has been an historic surge of all of us now online, and what permanent changes after the crisis passes are going to be coming to fruition?
Yeah, I think that's a really interesting question. So I think it's obvious to us all that the internet traffic is surging in a bunch of different ways as people move more and more of their lives online. One of the things that I write about in the book, and that I think is something that we have to really concentrate on going forward, is here in the United States, we still have 25 million people who don't have adequate access to broadband, 19 million of those in rural communities. And so when more and more of the day-to-day life of the country moves into this digital domain, like we have to make sure that everyone has a good connection to the internet. I think that's going to be one of these important things. And some of the shifts that we're seeing right now, like you can well imagine, are going to become not necessarily permanent, but just sort of pushing us in particular directions, like more work from home, for instance.
Kevin, I just wanted to ask you, as far as Microsoft goes with Teams, and we talk about the Zoom security issues, and we're all using video chat now. What kind of uptick are you guys seeing as far as Teams goes in recent weeks? I know that there was a huge burst of, more than 10 million people that signed up in the earlier half of the month as the outbreak started. But are you still seeing those kinds of increases for numbers towards Teams?
Yeah, demand still is very high. So like I can't say exactly what the numbers are, but like we continue to see really solid demand and really amazing growth.
All right, Kevin Scott, Microsoft's Chief Technology Officer and Executive Vice President, also the author of Reprogramming the American Dream. I think there's some irony in the fact that we're talking to you, the
All
Chief
right, y'all.
Technology
Gonna take a
Officer,
break from my
and I'm in
stream
front
for
of
a
a
bit. Play
Studebaker
some video
poster,
games with my
which is
buddy.
from another century. But, sir, all the best to you.
Hope you
I
guys
think we're
enjoy
going
the
to have more for
streams.
you on Yahoo Finance as we head towards 12.
I may be back on later. If you guys enjoy the stream, like this video, press the follow button, all that good stuff. See you guys later.